everyone who's here today. It's a great honor to speak at the Delhi Economic Conclave. I also am humbled to speak in India after the incredible experiences that you've had with trying to reduce the use of cash, which I certainly hadn't imagined when I been working on my book. My book, as I'll talk about, is aimed at advanced countries, although I do talk about India some. So my remarks today are based actually on a slightly newer version of my book, where I have a longer title, How Large Denomination Notes Aid Tax Evasion and Crime and Constrain Monetary Policy. It has a longer title because I found many people didn't even turn to the first page and see that I was about reducing the use of cash and not abolishing it. And I also have other related work coming out on other aspects. I think there's a general phenomenon if you look at advanced economies, but it's probably true in most emerging markets, some quite dramatically, where there are other ways to do transactions. It's not that the government's forcing people to do transactions in other ways, but there's innovation. So of course, a long time ago, there were checks, and then there were credit cards, and then there were debit cards, and now there are smartphones. And the use of cash in transactions is declining. In the United States, it accounts for less than 10% of the value of consumer transactions. And most of that is in very small transactions of $10 and $20. There are a number of other countries where it's less than 5%. And these numbers are falling pretty fast. I would imagine that in the United States, possibly within 5 years, certainly within 10 years, it will look like Sweden today, where the use of cash is well under 5%. And going down another 20 or 30 years, probably only 1% in legal tax compliant transactions. But even as the use of cash is shrinking in legal usage, its supply is expanding. Most of the expanded supply is in very big notes, $100 bills, 1,000 Swiss franc notes, large euro denomination notes, et cetera. That's true really in every country in the world, Australia, Canada. And the numbers are quite staggering. I'm going to show them to you. But in most countries, they're, a couple $1,000s. In the case of Japan, $7,000 or $8,000 per person for every man, woman, and child. And very little of it is really accounted for. I'm going to argue that a lot of it's used in what you call the informal sector, but what I would say would be tax evasion, crime, and corruption. So I want to start by stressing this point that going to a less, it should say less cash society or cash light society is not the same as cashless. The idea that I'm talking about and trying to force governments to think about more is not getting rid of cash, which makes no sense for a lot of reasons. In fact, I don't even think you need to change all that much the way ordinary people use cash, or that they would given all these new tools they have. The idea is to hit large-scale transactions, somebody wanting to buy a $40 million apartment in Trump Tower in cash, for example, large-scale crime and tax evasion. My book is focused on advanced economies, as I say a few times, although the Indian experience is going to be studied by economists for a very long time to come, and I've added a chapter on that in the paperback edition. And I've been working on this topic since 1998. I wrote a pretty academic paper with lots of statistics and regressions and theory back then, and I've continued working on it since. And I think there have been some other notable work. Peter Sands, who's a colleague of mine, he's at the Harvard Kennedy School, did a paper last year, and Larry Summers has very vigorously taken up the cause in his op-eds in the Financial Times in 2016 and since. So again, just one last time, not getting rid of cash completely. I think we need a physical currency around for as far as the eye can see. We can argue about what form that would take. I'm going to, at the very end of this talk about digital currencies, central bank digital currencies, all the different futuristic ideas that are out there. But I think even in that world, we'll want to have some physical currency. Now, there's a related idea that I take up in the book. It's maybe about a third of the book, which has to do with how advanced countries should fight financial crises. And I argue that in the future, with a lot of groundwork and preparation, negative interest rate policy would be a very much better approach than anything else that's being discussed. That is a cousin of the topic of reducing the use of cash. It is not the same thing. And as I will try to show towards the end of this talk, you can have $10,000 bills and still have ways to implement negative interest rate policy, but certainly phasing out large denomination notes and scaling back the use of cash, it makes it a lot easier to do. Sorry, just 1 second. I'm just going to. Excuse me, jet lag. So they're not the same thing. You can, the negative interest rate policy is different. I think scaling back cash is an elegant way to move towards it. And a very important point, particularly as the deputy governor of the central bank is here, this is not something a central bank can do effectively on its own. Not the Bank of Japan, not the ECB. They can take baby steps. But to do effective negative interest rate policy involves dealing with tax laws, legal issues, market conventions that at a minimum requires the whole government and really even more broadly the banking industry. If we're just talking about the legal economy, the topic of the session was given as the future of cash. Moving to a cash-light society is really not about telling people they can't use cash, but about all the other options that people are given. And I'll talk a little bit about Indian, or maybe more than a little bit, about India's demonetization, which viewed narrowly, I think was flawed in some respects. I think if we look at the larger picture of what the Indian government's been doing, not just recently, but going back almost a decade, has had many helpful steps towards financial inclusion that will make it possible for more people to use other means besides cash. And of course, there's biometric identification, which has helped promote financial inclusion, which is simply a remarkable technological accomplishment that countries all over the world may emulate. Now, in my country, there's really no thought of that. People don't want to have mandatory biometric identification, but that's probably going to fade at some point because either because we need it for cybersecurity and there's simply not a good alternative right now to biometric identification, or there's a traumatic terrorist incident which changes people's views. That actually had a big effect in Europe. The Europeans are stopping printing new 500 euro notes, and I think will eventually phase them out. That's worth something like $570 at today's exchange rates. It's at times been as much as $800. The Paris terrorist attacks were very important in making that happen. That may happen someday in the US, but it certainly had big effect on the ability of to achieve financial inclusion. Talk about that some. I want to be clear that I'm not viewing this as a morality tale, that it's bad to use cash. I use cash. I'm older. People in my generation use cash. I moved to these other technologies, but I'm slow to do it. I find, the use of cash being convenient in some transactions. It's hard to imagine doing tipping. And I'm not telling people that, even if the government says you can use cash, you shouldn't. I think we need to retain it, especially for privacy. But it's a question of scale. What kind of transactions does the government want to make very easy to do in cash? What kind of transactions does the government want to allow people to hide? Do you want to allow a large-scale business to operate without really paying taxes by using cash and have hundreds of millions of dollars stored away in cash? The Italians, by the way, uncover this all the time in their firms, and they find a whole chain going down in cash, and it's part of the reason that they have trouble collecting taxes. One of the many places I get sharp pushback is from Germany, and they say, oh, we love our cash. I'll show you the statistics on that later. They love their cash a lot less than they think they do. But they say, we love our cash. We have to have cash. And then I say, well, you know, if you got rid of the 100 and 200 and 500 euro notes, the Spanish and Italians and the Greeks would be able to collect more taxes, and you wouldn't have to bail them out. And that gives them pause when they think about that. So, you know, I think this is Peter Sands, in a separate paper, I mentioned him earlier, uses the example of the opioid epidemic, where it's very important to be able to use these drugs for relieving pain in many situations, but you want to regulate it to some extent. And I think to think of cash that way, just because something's good doesn't mean, you know, that you want to have it on any scale. Let me talk a little bit about Indian demonetization, and we heard from the finance minister earlier, and I think a lot of good points. You have to look at it in the context of everything India is doing. You have to look at it together with the gross sales tax that's been put on. You have to look at it together with all these efforts at financial inclusion. You have to look at the political side of it. Even if, and I think most economists find, the short-term effect on the macroeconomy was negative, maybe it allows political reforms that are positive. We often see that in political economy, where the government will do something which is one step back to make step forward. But just to be clear, in my book, I argue, first of all, to be very cautious about doing this if you're a developing economy. The financial inclusion issue, the fact that most emerging markets, developing economies, are very dependent on cash. So I mentioned the figure for the United States of about under 10% of the value of transactions are in cash. The equivalent in India is 70%. That's in value of transactions. In number of transactions, it's surely something over 90%. I argued for doing this very slowly. The pioneer in this idea was James Henry, who wrote about this in the mid-70s. And he actually he had been chief economist at McKinsey, and he's also was a graduate student at Harvard. He advocated this idea of doing it overnight for very similar reasons to what I think the Indian government said, which is to try to grab the dirty money, get at the people who are using it in crime, get at the people who are having tax evasion. And he wrote, we will have tax inspectors, justice officials waiting at the doors of the banks to greet the people trying to redeposit their money when they try to do it in a day. And what I wrote, I hadn't imagined Indian demonetization at the time. What I wrote is that, you know, there's so much money coming back, you're going to have to train an army of tax inspectors, bank inspectors to deal with this. How are you going to quietly train this army, have this huge expansion without anyone noticing that that's going on? And if you don't have the resources prepared, when everyone pours into the bank and it creates an enormous amount of collateral damage, you're going to give in. You're going to fold. You're not going to try to identify everyone, because if you're not able to do it in a very carefully planned way, there's too much collateral damage. And I think by and large, and again, there many people who know much more than I do about this here, obviously. My sense is that was the tack the Indian government took after a while of saying, let's minimize the cost here and try to make the best of it. So I recommended in my book taking 5 to 7 years, and that's after you start implementing it. You might have a few years studying it. Australia's doing that right now. They have a commission studying eliminating their $100 and possibly their $50 bill. Another point is that I'm arguing for taking bills of $50 and $100 out of circulation, and one could argue that India didn't have these. I actually think the biggest reason why, in the Indian case, it caused the problems it did was that you weren't just exchanging bills. And yes, I understand you introduced a 2,000 rupee note and weren't making into smaller notes. But the biggest single problem is didn't have the new currency printed. So you weren't just changing bills. You didn't have the new bills. And I think very few people understand this. I saw this in the European crisis where there were economists recommending that Greece immediately withdraw from the euro and have its own currency with no, in places like the New York Times, the Financial Times, with no concept that Greece was going to take 6 months to print the currency. What were they going to do? They had no practical understanding. Now, that isn't that there aren't ways of dealing with this. Countries deal with this in wartime, but it's very, very costly. It's a very high-tech process. Here's a picture, actually, of an Israeli printing machine. You can see it's just very high-tech. Like this is just one machine. I'm sorry, I will get pictures of the Indian machines, which I'm sure are very impressive as well. But even these take a very long time to operate. And so I think if you had to point to one single reason of why there were problems, that was it. Not to say that there wouldn't have been otherwise, but that was, you were really demonetizing temporarily. And then, we can read some of the statistics about how much came back. And again, I want to say that this is what I wrote early on, and I still think it's true. You have to look at the whole picture, and I really don't think we'll know for years the total effect. There are many, many papers being written about this, but I think there'll be more papers in 10 years reevaluating the papers that were written now, trying to understand the whole picture. How much will it energize financial inclusion? How much will it aid government tax revenues? How much will it give the government political cover to do other things? So let me turn to advanced economies, where the statistics really are quite striking. And frankly, they were already awfully striking in 1998 when I wrote my first academic paper about this. And I had realized for some time that the US had a lot of $100 bills out there, but I think people thought that that was some peculiarity of the United States, that people use the US currency all over the world, and maybe it's all abroad. That was what the Federal Reserve thought at that time. But it turned out, I showed in my paper, and I think other studies have also shown, it's pretty universal, that phenomenon. You look at almost any country, and there's way more cash than you dreamed there could be, or that you could account for in bank vaults, cash registers at businesses, what consumers report that they have, and what's actually out there, and that most of it's in very large denomination notes. And I make the case, I believe, the evidence is not nearly as strong. We don't have a lot of evidence, although there have been commissions, such as the UK had this thing called SOCA, Serious Organized Crime Agency, which sounds like it's out of James Bond, but it was a real name of an agency that wrote these very good reports for 5 years that show the phenomenal use of cash in crime and tax evasion, particularly large denomination notes. I want to just mention that there are many approaches to scaling back cash. I discuss them all in the book. This again mentions James Henry. You can have tighter reporting requirements of large cash withdrawals and deposits. We already have that to some extent. There are a number of countries in Europe where the problems with the sales tax, where Sweden actually wires cash registers so that there's a black box to record the information. A number of countries have adopted that. There are different approaches to this. I favor the reducing large denomination notes first because I think it would actually be pretty effective and relatively unobtrusive because most people aren't using them, but there are certainly other ideas. So this is a picture of the first of the United States, and it may not be that clear, but it goes from 1948 to 2014. The red line is the currency supply over GDP, which is creeping towards 8%, and the blue line is $100 bills, which is about 80% of the currency supply, and I'll show you in a minute that's pretty typical. Another measure is how much currency you have out there relative to your income. So there are a couple countries that are very low, but for different reasons. Norway and Sweden are very low because the government, and Denmark would be another example I don't have it's in my book, but not in this chart, where the government's taken at least a modestly proactive role in encouraging it. For example, in Sweden, it encouraged the banks to strip out ATM machines, to only offer cash at a limited number of branches to try to reduce the use of cash. The political economy of that had diverse factors. Nigeria is for a different reason, that there's been such inflation and undermining of the currency. That'd be the same thing with Argentina. But you see the United States there is about 7.38%. It's up a little bit. This is from my book, and now in the last year and a half it's crept up a bit. The Eurozone's more. There's India at 12.51%. Now I must say, obviously, we're taking the ratio to the formal economy, so you take into account that India's informal economy is very large. One might guess that the way cash is used in the formal economy is not so different from what it is in advanced economies, that it partly reflects a big informal economy. There are countries like Japan, which has an extremely high cash usage. Some of it's convention, and the Japanese like cash, but there's a fair amount of tax evasion in there also for various reasons. If we look at share of large denomination notes, where I'm, for most of the countries, taking roughly the equivalent of $50 and above, you see this striking phenomenon of how much of it is in large denomination notes. So there's Australia near the top, Japan's very high. Let me just try to put some color on this so you can imagine it. So in the case of the United States today, there's $4,400 for every man, woman, and child outstanding, of which maybe 40% is abroad. The US and Eurozone are kind of unique, and the US really the most unique. In the case of the Eurozone, much more of it's inside the Eurozone. So that still leaves a few $1,000s. There are some $3,500 or $3,600 bills for every man, woman, and child. And if I do a talk in an audience like this and ask, how many people have a $100 bill in their pocket, if it's a wealthy audience, you got a couple people raising their hands. If you say how many of you have 10, you probably get no people raising their hands. You need to have 20 just to have what every man, woman, and child has, even if you assume some portion of them is abroad. It's kind of the same everywhere. The 500 euro note had the nickname, the Bin Ladens, because everyone knew about them but had never seen them. And it's very similar across most advanced countries. So it leaves the question of where is it? And here, compared to when I wrote about it in 1998, there's a lot more data. Okay, I mentioned some of it's abroad. My own work in 1998 suggested that instead of 70 or 80% of it being abroad, as the Federal Reserve argued, at most 50% of it was abroad. And these are sort of the official Federal Reserve numbers now, where they have just over 40% of it is abroad. This gives, in blue, the whole currency supply, and in orange, the part that's abroad. And if you take out those numbers of what might be abroad, you get similar cash holdings to Canada and the UK, which has a similar banking system. And that's sort of the approach I used in my 1998 paper. Well, since then, there have been some rather elaborate surveys and sophisticated surveys of what people hold in their wallets. And what I have here is actually a little out of date. It's from my book. It's 2012. By the way, the website to my book has very up-to-date numbers such as they exist. And you see that the average American reports having $74 in their wallet. That's the mean, actually. The median's 37. Those numbers over a survey just a few years later have dropped dramatically. The 74 has become 56. The median's fallen further. But remember, even if we think 40% is abroad, you need to be holding $2,500 or $3,000. Well, they also ask people how much they have in their house and their car. How do you get it up to a couple $100s? But you're not getting it to $3,000. Here are the Germans who say they love cash, we only use cash. They're not holding 3,200 euro per person, which would be the average across the Eurozone. They report to be holding in dollar equivalents $123. And then there are some countries that are even less. So doesn't mean people are answering these honestly, but these are very extensive surveys that central banks and governments have done using fairly sophisticated methods. Another kind of information that has also been found from survey data, and also a diverse number of papers which use very sophisticated and extensive transactions data. There are a number of journal articles on this. Also look at what payments are in cash. This again, I will give you more updated numbers, the numbers from my book. And they give different value of transactions. So at the far left is less than $10 or less. At the far right is over $100. Green is how much is in cash. What's under $10, 2/3 of the transactions are in cash, because for lots of obvious reasons. But you start getting over $100, and it's actually, cash is a distant fifth, maybe even sixth. It's behind credit cards, debit cards, electronic transfers, checks, and probably even today smartphones for looking at higher value transactions. That's why the value of cash transactions is well under 10%. These numbers have dropped significantly even since this survey and more recent work. This is not real. This is from the classic television series Breaking Bad. That's Skyler and Walter White. They're looking at their cash, which he gets from his drug business, trying to decide what to do with it, how to, store it conveniently. And this was very well researched. They clearly, had a lot of the technical issues. And I think the issue of how to store the cash efficiently in small spaces is actually a big challenge. The Russian media recently reported on someone who was a high official in the Russian anti-corruption agency, and they raided his apartment and found $120 million, there may be $130 million, but most of it was in $100 bills, and they showed how he had stored in drawers and hidden in different ways. And whenever they do tax busts and drug busts, they often find the same thing. If you're keeping millions of dollars in your house, it's very efficient to have the smaller quantity of bills. If you're porting it around in a suitcase, if you're moving large quantities around, it's an issue. There are a number of countries that are trying to approach this. I mentioned the euro is phasing out the 500 euro note. The deputy minister, who's a good friend of mine from Singapore, gave a great speech earlier. Singapore actually had a 10,000 Sing dollar note, some of you probably know, worth about $7,000. It has discontinued that. It still has 5,000 Sing dollar note, although I think it does a lot to discourage the use of it. And the Nordic countries are approaching this problem from many angles that I could talk about in trying to discourage the use of cash. But even in Sweden, which people say is racing ahead to be a cashless society, it still has 5% of the value of transactions in cash. And if you look at small transactions, they're still, almost half in cash. So I think you need to look at this as cash light and not cashless. And I keep reiterating that point because there's so many people who say this is Orwellian, the government will know everything I do, how will I give money if I want my daughter to go down to the store and buy a chocolate. This is just polemic nonsense that you can certainly use smaller bills. And actually, if you're just buying a $100,000 or $200,000 apartment every once in a while, that's nothing to carry around in a suitcase. $100,000 in $10 bills you can fit in a briefcase, weighs about 22 pounds. If you're just doing that once every 20 years, I think you can manage. So it's really about people doing very repeated transactions. Now, I'm not going to have time to talk at length about the issue of lost seigniorage because central banks make money printing money. But I think that this is, and I've argued this for a long time in my work, penny wise and pound foolish to focus on this issue because yes, you make money from printing money. It's the government insists on having a monopoly. People use it. Not necessarily the nicest people always, but holding especially a lot of it, but they do use it. But when you look at the scale of lost taxes, when you look at the cost of crime, and I look at these numbers in the book, I argue that if you can cut back on these by, say, 5%, you can get a big win out of this. You can be ahead. Now, there are other issues, and I go all into this in the book, and I apologize, but I can't here. So central banks say, wait. What about central bank independence? Yes, the government comes out ahead, but we come out behind. What are we going to do about that? Of course, the government owns the central bank, so overall it's profitable. I believe that as we go to a digital future, as I'm going to be talking at the conclusion of this, the central banks are going to have revenues coming out of their ears from participating in this, and it's not really an issue. But it is important. I believe central bank independence is absolutely fundamental to maintaining macroeconomic stability and moderate inflation. And so, of course, you want to do something to deal with this question. Now, some people say, I know National Public Radio did a piece on this, and they brought in someone who was a reformed criminal who said, we just use uncut diamonds. We use gold. I don't need cash to do transactions. And yes, that's true, but the transactions costs are very large. Uncut diamonds, you have to have somebody look at them. It's very expensive to use them. It's not that there aren't alternatives. If somebody really wants to do a transaction, they can find ways to do it. I don't know if I dare speak about gold here, but gold coins, if you don't know the person that you got them from, it's not so easy to tell if they're legitimate or not. The Chinese make very good counterfeit gold coins using tungsten. A lot of laughs from people who've clearly seen this in real life. And so then people say, what about Bitcoin? What about Bitcoin? And I think there are a number of reasons Bitcoin is not going to replace cash. One of the reasons, of course, is that its price is very volatile. This is a picture of the market price of Bitcoin. Again, it's from my book, and so it's gone up quite a bit. Good investment if you invested it at the end of my book, which I don't say that it's a bad investment. In fact, I don't say gold's a bad investment either. However, a lot of why Bitcoin is successful is because it's anonymous on a relatively small scale. frankly, part of the reason the price went up is there was this ransomware going around asking for payment in Bitcoin. And people said, oh, wow, I want to invest in that. And of course, governments can push back on that. There are margins. They can prevent it from entering the system. They can prevent banks from taking it. They can make it illegal for stores to take it. And some people very naively said, oh, no, that's not a problem. The store just will lie and the consumer will lie. But anyone who's studied money laundering, and I believe the Indian government in implementing the GST tax and requiring the reporting of business-to-business transactions is very familiar with this. It's not that easy for a store to lie about its sales without lying about its purchases, and whoever sold it the goods has to lie about its purchases. That's why when they catch one of these firms in Italy with 500 million euro in their vault somewhere, they quickly find out that all the suppliers were taking cash, and the suppliers to the suppliers. By the way, a lot goes through the mail service and postal service, so somehow you have to control that. I think it's not that easy to do. In fact, I think a more likely outcome is that over time, government regulation of this will be more sophisticated. Most governments have taken a very hands-off approach to Bitcoin, which I think is smart, with the idea, let the innovation come, because later we'll appropriate it. And if you look at the history of innovation in currency, from the earliest coinage to paper currency, the big innovations, there's debate among historians, but I think a reasonable interpretation is what it says here: the private sector innovates, and then the government eventually appropriates. I do think we will see central bank digital currencies eventually using some of these technologies. Every central bank, well, excuse me, maybe not in India, but every central bank I've spoken to about this has somebody working on it. The Federal Reserve claims they don't, which would just be ridiculous, so I assume they do. Sweden, China, the UK, and Canada are very openly looking at the idea. In short, it's not that easy to do at a retail level yet. And when the central bank has a digital currency, it's not going to be anonymous. And so it's not a complete substitute for cash. And I do think it's important to retain cash. How much time do I have?
As much as you.
Well, I'm not going to use as much as I just want to, you know, I want to be careful not to wear out my welcome. So I've talked about cash, and I want to talk a little bit about this sister question, which is related, but you can go to negative interest rate policy without doing anything to cash. You can expand cash, and you can reduce the use of cash and prohibit central banks from using negative interest rates. So, as many of you may be aware, after the 2008 financial crisis, there were dramatic interest rate cuts. But I think the Federal Reserve would have liked to cut interest rates much more. Standard Taylor rules, rules that central banks use, say they would have liked to cut rates more. The European Central Bank also would have liked to cut rates more. In fact, they actually have gone below zero in Europe and Japan. And I think as of today, we have some $8 trillion in developed economy bonds trading at very mildly negative interest rates. But nevertheless, there's been a constraint on that. That's a picture of that fact. But even if you can go a little bit below zero, there are a number of reasons it's a problem, not just cash. There are also market conventions, tax rules. Although I think, and I talk about this extensively in the book and in my forthcoming Journal of Economic Perspectives paper, these are pretty easily dealt with. The big one is cash. Central banks are afraid that if they lower interest rates too far, everybody's going to be holding cash. It's not cheap to hold cash. There are all sorts of insurance costs, and especially, we're not talking about individuals. By the way, my plan for negative interest rate gives a significant exclusion to individuals and small businesses. We're talking about pension funds, insurance companies, and they have looked into this in places like Sweden and Switzerland, which have gone more deeply, slightly more deeply into negative rates. They look at hoarding cash. And if everybody did that, the problem is you're lowering to negative rates in order to try to encourage investment and consumption. But if all the money is being pulled out of the system, it won't get passed on to anyone who wants to invest or wants to borrow. So that's the reason cash is a problem. And by the way, there would be massive security problems. Can you imagine if there are all these vaults all over the world and we take the $18 trillion in US debt and convert half of it to cash lying around all over the place? It would cause a lot of security problems, and even just transporting it is very difficult and expensive. If you could overcome these problems, there are people who sort of think having negative, why I've extended the title in the paperback. But I also get a certain amount of this about negative interest rates. It's particularly from bankers who are worried about this happening too quickly, which I don't propose. I propose this being phased in very slowly, think of 10 years from start to finish and trying to phase it in. But there's still people who just think it's not natural. So there are people who claim it's never happened. James Grant claimed that in one review in the Wall Street Journal, evidently unaware of the history of coin shaving, that had happened all over the world when we had metallic currencies. And of course, we have negative real interest rates. If you have, the reason we're having this problem with the zero bound is because the inflation rate's very low. And if the inflation rates were high and you still had interest rates a little bit above zero, you'd have a big negative rate. You've had that in India, but the advanced countries had that all over in the 1970s. People forget that the UK and Japan had inflation over 20% during that period, and interest rates did not compensate. And then there are people who just very mechanically say, well, it's just got to be bad for savers. Well, I have in mind using negative interest rate policy in a deep financial crisis. We wish we'd used it in 2008. Keynes, as I will point out, very much advocated using this in the 30s. And there are people who say it's just bad for savers. Well, you know, for one thing, if you look at savings more broadly, housing, stocks, they're going to go up if you have interest rate policy like this. But also looking at longer term bonds, if you're raising inflation and raising growth, you actually raise the longer end of the curve. So it's only if you put all your money in overnight deposits, which only people with fairly small amount of money do, and I think you can easily exempt them. And so yes, there's some risks. People talk about that too. I've had a number of people debate that point. But if you're in a financial crisis, everything is risky. And when I show you some of the wacko policies that have been proposed instead, I think negative interest rate policy looks pretty tame. So then there are people who say central banks are already doing a great job. We don't need this. Everything is completely good. We'll never need to use this policy in a big way. And the US Federal Reserve has tried to argue this, saying they did these other policies like tell people, well, we can't inflate now, but we'll do a lot in the future, we promise. Or we're doing these swaps of long-term and short-term bonds called quantitative easing. Just a parenthetical here, I want to say that if you have a deep financial crisis, you need to do a lot of things, fiscal spending, structural reform. It's not all about monetary policy, but it's a big factor. I'll skip this, which was this is a graph Janet Yellen, the Federal Reserve Chair, showed of how negative interest rate policy would work, which illustrates a lot of the points I made. And she said, well, that might be a hypothetical ideal, but what we do does almost as well. There's a great cartoon about quantitative easing, if you haven't seen, called Quantitative Easing Explained. I won't play it for you here, but the idea that quantitative easing is a substitute for negative interest rates, I favored what central banks did. Quantitative easing is basically issuing short-term central bank debt and buying up long-term government debt and sometimes private debt. I favored quantitative easing, but it's a very weak tool compared to negative interest rates. I think that's what a lot of economists think. I think the consensus among most economists is that the tools central banks have for dealing with the zero bound are pretty weak. And so the journal articles, which you may not see in the media and may not see in popular conversation, but will be coming, the journals are filled with these other ideas that you should do. So I list just a few of them here. Maybe trade protectionism, like Donald Trump and Bernie Sanders advocate. It's not so bad when you have a financial crisis because, goodness, it makes prices go up. There's an excellent series of papers by Gowdy Egerton, I was at Brown, with various co-authors. They're very clever, saying, you know, when you have a financial crisis, don't reform. So that's saying, you know, never miss the opportunity to take advantage of a crisis to do structural reforms you wouldn't do otherwise. It's wrong. You shouldn't do structural reforms if you're at the zero bound because structural reforms make things more efficient. They make prices go down. If prices are going down, it makes the interest rate minus inflation higher. No one will invest. And you can produce models where that's true. I think it goes without saying that I think that's not a very robust result, particularly looking at the long term. Paul Krugman and Lawrence Summers are among those who co-authored with Gowdy. And these are very clever papers, but at some level, it doesn't have the ring of common sense and probably isn't. There's helicopter money that I had the office next to Ben Bernanke at Princeton before I moved to Harvard, and we shared an office in graduate school, and he's an incredible, brilliant man. He has aired this idea of helicopter money, and there have been a number of others take that up. And I can only say that helicopter money is printing money and giving it out to people. I can only say that it offers nothing that fiscal policy plus monetary policy doesn't offer. It doesn't change anything, and it, you know, might work temporarily as smoke and mirrors as a disguised form of fiscal policy, but fundamentally central banks, and again I don't know everything about India, but central banks don't have the right to hire helicopters and drop money out of them. That is fiscal policy, and if you're stuck on fiscal policy, you're stuck. So another idea, which was really the centerpiece of Keynes's 1936 book, was you use fiscal policy on steroids. So you should use fiscal policy even if monetary policy has negative interest rates. You still use fiscal policy in a deep financial crisis and even in a very deep recession. But if you're stuck at the zero bound, the arguments you use much more. You make the government much bigger. I think for many economists, this is a way of a backdoor to getting the government be larger. Again, it's logically consistent, and Keynes beautifully illustrates that. But an ideal policy would be to have a mix of monetary and fiscal policy where you're using both. And then I would say a final idea, which I'll segue into India briefly again, is to raise inflation targets. Part of the reason we have this problem with interest rates being zero is people just think there's never going to be inflation. And if you could convince them inflation would average a higher number, all interest rates would drift up. And when you had a financial crisis, you could react more forcefully. And there have been, this is a reasonable idea, I think, and it would be a long digression. It's much less elegant, it's much inferior to just clearing the way to have effective negative interest rate policy. One point I would make that's obvious is if you promise 2% forever and you have tens of trillions of dollars of contracts and bonds predicated on that, and suddenly the Federal Reserve said, oh, we changed our mind, it's going to be 4%. It's going to roil financial markets. It may, you know, create problems of its own right. And people will wonder, well, wait a second, you said 4%. Maybe you're going to say 5%. We actually have had papers on that. how do you know it was 4%? And there are other problems of faster rate of faster indexation. You will find that monetary policy is less effective in normal times when inflation's higher, because indexation will eventually be higher, prices will be changed more often. And you might find, when you finally get to that next financial crisis in 20 years, monetary policy has been so diluted that the extra space you thought you were buying by raising the inflation target all gets used up. You achieve nothing by having it. So anyway, I discussed this. I should say, in the case of an emerging market, I think the logic of having a higher inflation target, as India does, makes a lot of sense. But I would say, this maybe is only a footnote for India, but maybe not, of not rushing to have a much lower inflation target. And there are countries such as Korea and Mexico which already have higher inflation targets. Again, I think the negative interest rates is a better option. So Keynes he actually had a whole chapter about this in his general theory, and he goes in great detail saying, I love this idea, but it's impossible. You cannot do it. There's just no way to do it. And so part of the reason all these academic articles in the best journals, all the leading journals start out with, well, we know you can't have negative interest rates, so here's an out-of-the-box idea you should do instead. I shall say, I've already mentioned that I think a lot of these things are kind of crazy if you really could do negative interest rates. To compare Keynes's day to today with what it involves is ridiculous. We have cash much less important. We have electronic payment systems which make the accounting for negative interest rates very easy. And in my Journal of Economic Perspectives paper, which is about to come out, I described the economic profession in sort of a play on the old joke about economists. There's all these articles say, suppose we don't have a can opener, how would we open this? But maybe we do have a can opener, and that's what I want to talk about. So there are a few different options for dealing with the zero bound. One way is to find ways to pay negative rates on paper currency. I'll talk about that. One way is to eliminate paper currency, which I think is a bad idea. And then there are a couple other ideas which I think are credible. One is reducing large denomination notes, getting rid of large denomination notes. And then there's another more complicated idea I'm not really going to be able to explain, read the book, but it's very clever. So there was a German economist who proposed having negative interest rates in Keynes's day. That's his picture on the left, Silvio Gesell. And they're actually, I found in the course of writing this book, they're clubs about him and lots of correspondence and books about it, where he proposed you take your currency and say once a month you have to go and buy a stamp, put it on the back, and if you haven't kept up to date, your currency is no good. So that's a way to charge a negative interest rate. And if you think that's kind of crazy, here's Irving Fisher, the older man on the right. He's there with his son, who's certainly one of the economic geniuses of the 20th century. He just loved this idea. He wrote a book about it. He wrote to President Roosevelt that we should do this in the United States. This was the solution. And they had much the same ideas that we have today of how negative interest rate policy would work to help stimulate investment, growth, to pull you out of the recession. Gesell didn't make a distinction between being in recessions and not being in recessions, so I kind of think if we did things his way, we just have a ridiculous amount of inflation. That's not the idea. I mentioned Keynes actually praised Gesell, but ultimately said that isn't very practical, and money wouldn't be very liquid, and it would become a lot less useful. But it was a centerpiece of his logic. We can't, I wish we could do this, but we can't do this. So in modern times, a number of economists have tried to suggest ways you could do it. And here's Marvin Goodfriend, who's discussed at length in my book. I'm not sure how this plays out, but he his name's being discussed for the Federal Reserve Board as the next Trump nominee. He's a really good guy. He's really good. So I endorse that if that's actually what they're going to do. He's a good general economist, even whatever you think about this idea. He wrote a paper in 2000 saying, hey, look, we could just put magnetic stripes in the currency. And I learned that he got all sorts of, hate mail, right-wing talk radio, treated him as the villain of the year for saying this. I think that idea is not that practical. The idea is when you put it back in the bank, they would see how long has it been out of the bank. If it's been out 2 years, we'll charge you twice as much as if it's been out 1 year. You have a negative interest rate. The problem is if I give you the bill on the street and you don't have all this equipment, you don't know what it is, and so it's not very liquid. And Greg Mankiw proposed, tongue-in-cheek, an idea about using negative lotteries. And if you lose, if you have a losing digit, your currency is no good anymore, and that's another way of making your currency no good. And by the way, like many monetary experiments, the Argentines had long ago tried this out. So Greg said that's the only time that the president of Harvard got letters that he should be fired for daring to say something like that. What Keynes didn't know about was there was this outsider who was only really discovered much later named Robert Eisler, who had a much better way of doing this. So I mentioned there are two different ways of paying negative interest rates. The simple ones just make it very expensive to hoard cash, get rid of large denomination notes, possibly add some charges to redepositing cash at the bank. It's pretty simple. This is more sophisticated. Won't be able to perfectly explain it. You can read the book. But I show that this idea of Robert Eisler's, which he traces back to the colonies of the United States, actually goes back to Kublai Khan, who was the grandson of Genghis Khan, and they had the Mongol Chinese emperors had one of the first paper currencies. That's Robert Eisler on the left. That is actor Benedict Wong on the right, who plays Kublai Khan in the television series about Marco Polo. Marco Polo came to the court of Kublai Khan and actually wrote about how Kublai Khan's currency worked, and Gordon Tullock, a great monetary economist and historian, written about this. This idea has been rediscovered in recent years, and on the left is Willem Bouter, who rediscovered this idea, and Miles Kimball. I will just give the briefest of explanations, which is basically the government sets up an exchange rate between electronic currency and paper currency that moves over time. And so when you redeposit your paper currency at the bank, the amount you get is that exchange rate. It doesn't matter whether you took the money out a day ago or 5 days ago, you get the same exchange rate going in and out of the bank with this electronic currency. It's a little dizzying thinking of having two currencies and their various issues, but you don't need to get rid of cash. So let me conclude. This was the cover of the hardcover version of my book, and the zero bounds explained in the second half. This is the paperback which just came out, and I've added this how large denomination bills aid crime and tax evasion and constrain monetary policy, in order for the people who don't make it to page 1 to realize that it's not abolishing cash. And again, the Indian experience is absolutely remarkable. We'll all be studying it. I give a discussion of this in the paperback version, but I think the book is still very much open to evaluating the Indian experience. Thank you.
Thank you, Ken, for this very insightful remarks on a topic that's very germane to the Indian setting right now. For those of you who don't know about Ken's earlier work, I have this definition of a genius. It's not my own. I heard from someone else that a genius is someone who has two good ideas. I think in case of Ken, the number of great and good ideas is just innumerable. If you are doing something to understand why sovereign debt exists and why people are willing to pay sovereigns even though they have no easy way of getting their money back, like a bankruptcy system, I think you have to go back to Ken's original work with Jeremy Bulow to understand all this. If you're thinking about why governments shouldn't become too large, because that might actually defeat the very purpose of generating growth in the first place, you can go again to his book with Carmen Reinhardt on This Time is Different, that covers debt-fueled boom-bust cycles over the last several centuries. And, you know, just lo and behold, he really has this amazing book that tries to explain cash and its various ramifications in a very powerful way. I think what I got from Ken's talk were two powerful ideas, that cash is attractive to people because of two reasons. One, it gives you anonymity in your transactions, and it by and large also gives you some convenience. And I think at the intersection of this anonymity and convenience is, of course, things related to tax evasion. I think evading taxes could be, is possible if you can keep your transactions anonymous. And it's a form of pecuniary convenience. I think all of us who've grown up in India, we know that more than 80% of savings on average for an Indian household is in the form of property. And I think everyone aims to do this, and therefore they keep building a pile of black money as soon as they have their first salary hit their pockets in one form or another. And I think we seem to have come up with a very clever innovation, or jugaad as we would like to call it, which is that we by and large don't store cash that much. We've figured out through this system of gold and real estate holdings that we'll just keep it moving in the system like a hot potato. The cash is just constantly lubricating all these transactions, and in a way, therefore, the collateral damage that Ken was referring to when you suddenly stop having cash in the system also has played out, I think, in one way or another in the economy. I wanted to mention one thing and then ask Ken a question. The one observation that I've had about the recent Indian experiment has been that there's something interesting going on in terms of financialization of savings. So coming back to this point that the average Indian household is keeping more than 80%, perhaps even 90% if you include gold and real estate together. I think this seems to have had a pretty non-linear shift since November and December. The flows that are going domestically into mutual funds, structured investment programs as a form of savings. If you look at the insurance premia collections over the last 7 to 8 months with all our large insurers, these are all massively on the rise. While there are other explanations that should be tested, it seems that perhaps a little bit of wrinkle in maybe a middle-income Indian household thinking whether it's a good idea anymore to actually keep everything in black or to keep everything in real estate. Maybe it's time to what's become white in your bank deposit, keep it white by going into financial assets until maybe a tax authority gets back to you. Maybe they won't, but at least you would not have done 2 black to white transactions back and forth, once to get your currency changed and then go back into the black money circuit. And I think there's something remarkable going on, maybe almost a bit dizzying and worrying at some point, is that I imagine that if this continues, it has basically changed the discount rate on valuation of financial assets in the following sense, which is that if you thought that stock market holding or bond holding was not that attractive from a tax evasion perspective because it's all open, it can be traced very easily. In some sense, your tax adjusted discount rate on these cash flows was very large compared to, say, going into gold or real estate. But I think I sense from the flows I am observing in the financial assets that something has changed in the way people view black money transactions, the ease of just going and buying another property with your savings, perhaps fearing some action maybe because it's hard to hide a big property transaction if someone really wants to go after you. Maybe it's easier to hide some pieces of gold here and there. So I think we have to wait, and I think Ken is right. It will take us many years to understand which of the various explanations are right. But with that sort of slightly long rejoinder to Ken's remarks, I had one question for Ken, which is on this idea of digital central bank currencies that's, I think, picking up hold. One of our just retired deputy governors, DG Gandhi, who was in charge of all the currency management operations, he also used these two words, anonymity and convenience, as the reason why people are holding cash. His explanation for why Scandinavian countries are moving faster to electronic currencies was that it just took coal to go to the bank, and so it's easier to use wallets. It's just very convenient. That may not explain Nigeria or Argentina, which also seemed quite high in being very low cash usage in the economy, but maybe that has to do with crime or something like that. Maybe they use dollars. Yeah, that was my dollars. Yeah, exactly. So the question I have on digital central bank currencies is that it seems that by default, if it is digital and it's a central bank transaction, it will always be recorded. Like the moment a transaction takes place, a central bank would know, and won't that make it very unattractive to people to use that for doing transactions?
Yeah, I mean, you have to have it be recorded, otherwise no one will pay. They'll use digital currency, be a superior version of avoiding taxes and corruption to what you have now. But I think we're moving in that direction with no central bank digital currency. The questions providing a convenient alternative for poor people, providing financial inclusion, there are different approaches. You can force banks to subsidize low-income people, but I think the central banks are looking at it, and they're very, very far from implementing it, are trying to ask themselves, the question about whether they can provide at least what I describe as a public alternative. But think of digital currency as an alternative to debit cards, credit cards. It's called digital currency, but it's not. It's a digital debit card. It's a central bank debit card in a way. But by the way, I mean, China's ambitions may be greater than that. Under the way things are moving currently, the dollar is actually getting stronger and stronger, and the day where the yuan, the RMB, is going to take over from the dollar seems farther and farther away. If they created a digital platform that was just way ahead of everybody else, that could accelerate that transformation, and they may have that in mind also.
I see. That's great. So with that, let me open up to questions. Ken has, I think we have at least 15 minutes for several questions, and Ken has kindly agreed to take most questions relevant to the topic, including on chess. He said he's a chess grandmaster, as many of you know. So, yes, I think, yeah, please.
The Indian demonetization exercise, I know that
we have, say, a £5 note, and we're going to have a new one. The old one's good, but after 8 years, it's no good. That's very common. In fact, I somehow had an old £5 note stuck in my wallet this summer, and I brought it to the store and said, well, that's no good anymore. You can take it to the central bank and get money for it. That's very common. What is not common is announcing it overnight that suddenly you can't use it. That's something usually done only in wartime. The U.S. did that in Vietnam with it. Didn't have the dollar currency, but a script currency. So it's been used, but I'm not aware. I think probably it's been researched here, but I haven't seen it that someone's done exactly that. Now, he asked a separate question, which is, well, the government says we can't use it, but what if we just use it among ourselves? We have an alternative currency. And I deal with that question in the book I got asked that question by a very good colleague of mine. I think the answer is it's not very liquid. So when you get paid $1 million in $100 bills or $20 bills, eventually you want to spend it, you want to use it. So, I mean, Bitcoin has that problem. There's certain things you can buy with Bitcoin, but there are an awful lot of things you can't. If you want to hire a contract killer or buy drugs, it's you know, your dream currency. But if you want to take it to the pharmacy, it's not. And so I think that's the problem with I think the parallel currency, if it couldn't be recycled into the regular market, would ultimately fade. I don't know what's going on here. So maybe, I gather it's even illegal to hold the notes here, which is even stronger than saying you can't use them. But it was quite unique, to my knowledge, in peacetime, certainly at this scale, India's absolutely unique and original implementation.
I think we have a question from Dr. Rakesh Mohan, former deputy.
Monetary policy and only using monetary policy. And so when negative interest rate policy came in Europe and Japan, it was already exhausted to some extent. And I'm particularly looking at what if we have another financial crisis, being able to use this tool. I still expect normal interest rates at some point to rise enough that it's not that relevant most of the time. But yes, absolutely. Certainly in a deep recession, it's a big effect on small businesses. It not only, it works from two sides. It stimulates investment and consumption, but also chases money out of the banking system. People, the banks just happily hold the money at close to zero. Now they're able, in most of the advanced countries, to pass on the rate to their wholesale depositors. But yes, obviously we have extensive experience with negative real interest rates. In principle, negative nominal interest rates ought to look the same if we deal with tax laws, market conventions. The Swedes and the Swiss and the Danes have sort of rolled through those problems pretty effectively by and large. So I think it can be done, but yes, it is a question.
No questions. Let me take one there. Mr. Ajit Ranade. Yes.
Hi, thank you. My name is Ajit Ranade, and thank you for
problem of growth in all the advanced countries around a lot of the world. And again, the Deputy Prime Minister of Singapore spoke very eloquently about this, where at the moment productivity is low. In many countries, demographics are adverse, and many countries are struggling with this. So in Japan, frankly, they all know that immigration would help a lot. They have a declining labor force, that there's nothing you could do with monetary policy or fiscal policy that would substitute for finding ways to expand the labor force. And I had a short slide, I should have dwelled on it more, saying monetary policy is not a panacea. You asked specifically about capital controls, and I'd certainly say the modern view is eclectic towards them. Many countries have substituted having larger reserves for capital controls in order to stabilize their exchange rate, particularly in Asia. But I think particularly capital controls on large-scale inflows is an idea. Controls on outflows, I think there's much less, what you're saying, to hold the money in the country. I think at very low stages of development may be effective. I think as you develop a more sophisticated financial sector, which you need to, this gets harder to do. But it's an interesting question. I wouldn't be at the top of my list at pro-growth proposal. If I look at India and look at the list of things India would do with things like infrastructure, labor market reform, it wouldn't have gotten that high on the list. But I don't have a dogmatic view towards it.
Sorry. Yes, please.
You gave the example of the US and the UK where 40% of the currency is outside the country.
Only the US, not
US,
the UK.
okay, US, 40%. So one of the arguments that we could make in India is that we could do it, that's why we did it. You can't do it on an overnight basis. If the US was to do it, it would probably not be able to do it. And my second question to you is that you had mentioned that India could have done it a little differently. Apart from the fact that you mentioned that notes could have been printed on time, is there anything else that India could have done differently to lessen the pain or the adjustment process?
Yeah, I mean, the first point of, and again, the US, there are only a few countries which have significant cash outside the country, the US, the Eurozone, Switzerland, and perhaps Hong Kong. And for everybody else, it's almost all held internally, as far as the central banks know. And they have quite a bit of information on that. And yes, I talk about that in my work, that for the case of the US, when I'm talking about James Henry's idea, it's going to look a lot like debt default to the rest of the world when you do this, and it's one of the reasons you can't. But my book's looking at all the advanced countries, so that would be unique to the US. You know, again, governing India is a very complex task involving political constraints, economic constraints, the states, the federal government. So trying to understand exactly what was the perfect way to do this, I don't think I can pretend to know. But I feel that of all the points raised, if there's one thing you could magically have done, and I understand why it wasn't done. It was explained very clearly by the Prime Minister and his aides that they were afraid if the RBI had printed the money, eventually people would have found out. By the way, I think Germany kept enough Deutschmarks around for a long time to pull out of the euro suddenly if it wanted to, because it was keenly aware of this point. But if you could have had the currency on hand, and it could have been the same size to fit in the ATM machines and all that sort, I think it would have been spectacular, but had much, much less effect. I read about Bollywood stars who promised not to use cash so their ration could go to poor people. I'm not saying that suddenly everything would have been, but that's the overwhelming effect that I think the economy felt. That's why it's less now, because cash is available, at least. I think it is. I won't put you on the spot. I mean, as far as I understand, it's available, and so it's over with. The facts that the problem wasn't the exchange of cash. The cash was they had no physical, not nearly enough physical currency to exchange it with, and I think that's the dominant effect.
I think we have time for perhaps a couple more questions. So let's say one. Yes, sir.
Is sort of, I can segue from the last into this. The main problem you see was the rapidity of this transition. But just about the time you joined the fund, if I remember correctly, the fund was looking at another issue related. Some economies which were dollarized were thinking of de-dollarization. And I remember there's some analysis, people reporting whether that should be done overnight or over a period of time. I remember hearing Tamim Bayumi, for example, come and explain it to us in the bank. So I'm wondering, are there any lessons, or do you recall that sort of analysis about?
So Tam Bayumi is a fine economist, and I don't particularly recall his work on this right off the top of my head. But in general, doing anything sudden is very difficult to do unless you're doing it in a crisis. So oftentimes these things were done in a crisis. The country's on the verge of default, et cetera, that it's difficult, to do these things overnight because it's just, money is so deeply entrenched in the economy in so many different ways. You can cause collateral damage that's not intended, and the usual thinkings that it's not something, well, I shouldn't say it's the usual thinking. My thinking about it is that it's better to err on the side of caution. A doctor shouldn't make things worse. But again, with the case of Indian demonetization, it's a very complex problem. There's all these things being done with financial inclusion that you're trying to energize. There's the gross sales tax coming in. So it's a very complex picture, which I think won't come into focus for a long time, although I don't want to overly soften the critique of it. I don't think there's any question that A, output went down. We don't know how much, because a lot of it was in the informal sector, and that B, so far, if some black money was going to be, taken over by the government, it hasn't yet been done in any large quantity.
Okay, we have one last question. Okay, I'll give it to Arvind since he's invited me.
The drama, it's so visible to everybody. You're really going to fight corruption. And, I think there are some policies that people will endorse to give it a try because it feels so good, even if it hurts. And I think there's a huge psychological effect. So, from what little I know, and I want to say I know little, my sense is that politically it was a masterstroke. And then if that's true, I think the challenge going forward is how to make use of that capital to say, I'm going after corruption, I will do anything it takes, and you can be sure that I'll keep trying other things. And again, the way that GST is being implemented, is something that certainly can help promote higher tax compliance. So I think not just should economists study this, but this is clearly a fascinating topic for political economists, political economy, and will be much in the future. It's a very interesting the way you've put that, Arvind.
Mr. Nandan Nilekani is the former chairman of the Unique Identification Authority of India. Mr. Nilekani has been the recipient of one of India's highest civilian honors, the Padma Bhushan, in 2006. He's also one of India's most successful entrepreneurs. We are privileged to have you here, sir.
Dr. De Broglie is a member of Niti Aayog, the think tank of the Indian government. He was awarded with one of India's highest civilian honors, the Padma Shri, in 2015. We are grateful to have you amongst us, sir. Now we would like to request Mr. Nilekani to kindly commence the session.
Good afternoon, ladies and gentlemen. Let me thank the Conclave and particularly Dr. Arvind Subramaniam and Sanjeev Sanyal for having shown me the honor and the privilege of moderating this session. A moderator is supposed to moderate himself. Nandan Nilekani has just been introduced. What the introduction did not say is that he was very fond of quizzing. So after he has made his initial presentation, it's the opportunity to quiz him on everything under the sun as long as it has something to do with data. Having said that, it's all yours, and we'll make it interactive after his initial presentation.
Thank you, Vivek, and it's really great to be here amongst all of you, and I'd like to thank Arvind. This is the second time that he's invited me to this prestigious event, so I'm really grateful, Arvind. So today I'll talk about a topic. It's going to be slightly provocative. So the topic is data is the new oil, and my theme is that how, and this is not a new thing, there was a recent Economist cover on data is the new oil, and since this is a group of economists, I'm calling it macroeconomics for an unlimited resource, since it's a different kind of resource which is unlimited. Now the world is becoming rapidly with more and more data. For example, half the world now uses smartphones. We have 2.5 billion people using a smartphone, and when they make the migration from their existing phone to a smartphone, the amount of data that they generate goes up dramatically, because a phone has multiple sensors, it has a GPS, accelerometer, gyrometer, all kinds of things. All of that is beaming up information, most probably to one of your apps or to your smartphone provider. But it's not just about smartphones, and of course yesterday Jio launched a feature phone, which is a data feature phone that will create again a lot of digital footprint. It's also about the new devices that are coming, and if you look at the data in 1960, when we all had mainframes, and many of us were using mainframes in 1960, the ratio of people to machine was 40 to 1. Those of you who went to college in those days remember punching cards and going in the night to the computer center. But today we are entering a world where it's 4 devices to a person. So we are going from 40 devices, 40 people to one machine to 4 devices per person. And this is just where it's going on devices. But the other big thing which is happening is what's called in the buzzwords as IoT or Internet of Things, which is that every car, every refrigerator, every microwave will have multiple sensors. And the estimate is that there will be 50 billion of these devices online in the next 4 to 5 years. So you can imagine a world where, and this is going to happen, you know, whether you like it or not, it's going to happen. Imagine a world where everyone has 4 devices that is generating data. Every vehicle has 50 sensors, every fridge has sensors. So you're simply seeing a tsunami of data, an explosion of data at a scale unprecedented in human history. And everyone and everything will be connected. So every person, everyone will be connected, and everything will be connected. And a good example of that is a company called ARM, which sold 15 billion chips in 2015, is expected to sell 1 trillion chips by 2035. And it is really, ARM is the heart of the smartphone. It's a British company, and that's the reason why Masayoshi Son of SoftBank bought it recently for a very large sum of money, because ARM is really the chip which has become the heart of this economy. So your world where everyone and everyone is connected, billions of devices, billions of phones, billions of sensors, all of them are creating digital traffic, digital footprints. The other big change that has happened in the last 10 years or 15 years is that increasingly the thinking of businesses is how to build platforms. Earlier we built what we call as pipes. You produce something, you had a distribution channel, you sold it. So you're a big manufacturer of soap. You produced it, went to a large retailer, you got shelf space, you sold the stuff. And that is what is called as a pipe. But increasingly now it's an era of platforms. And platforms, for example, all the major guys have platforms. Facebook has 2 billion users on their platform, Android 1.6 billion or so. Even the industrial giants are talking about platforms. GE has built a platform called Predix, which is what they use for their Internet of Things to connect all the jet engines and so on. Now, platforms are very unusual because they not only solve problems, they also capture and claim ownership of data produced by user interaction. So the big thing about platforms is they capture the data which is a byproduct of every interaction of every device and every person with that platform, right? So when you use social media, all your social media is in the database. When you do a search, all your search details are with the search engine and so forth. So this is happening to all the platforms. So platforms are aggregating data. And you can see that this has created huge businesses. If you look at the United States and you look at the functioning of the markets, the big thing in the last couple of years is the growth in market cap of a group of companies who are all platforms. Apple, Amazon, Facebook, Google, Netflix. Some people call this as FANG. Facebook, Apple, Netflix, Google. Some people call it GAFA, Google, Apple, Facebook, Amazon, whatever. The point is that these are the high performing stocks, and their valuation cumulatively is in the trillions of dollars. In fact, many of them individually are expected to reach $1 trillion market cap. And exactly the same thing is happening in China. If you look at the Chinese companies, the ones with the big market caps are all data companies. That's called as BAT, Baidu, Alibaba, Tencent. And they again are running into market caps of hundreds of billions of dollars. So basically, the way you can think about it is that 7 or 8 companies in the world are becoming massive aggregators of data on their respective platforms. And data is its own means of production. So data goes into a cycle. So the more data you have, you create better products. The better products you have, you attract more users. The more users you attract, you create more data. So this virtuous cycle of data is something that is now becoming apparent in all these companies. And this is also, because of this behavior, it leads to what is called as a winner-take-all situation, where the bigger you are, the stronger you get, and the more difficult it is for somebody else to come into your space. Now this goes against the classic issues of competition and antitrust, because when we thought about competition and antitrust, and from the time of Standard Oil and the US 1911 antitrust and so on, people talked about what is the impact on consumer welfare, or people talked about are these guys going to raise prices because of monopolies? But the reality is, in this data business, they give it free, so there's no price issue, and they give you very good service. So if you take a classical monopoly view, you're saying, what's the problem? It's, everything is fine. But in the meantime, the data is, because you're creating these large platforms, you're actually creating very large monopolies, and that's becoming a big issue around the world. And what is happening is, because since I was at a conference of economists, I said this is an unlimited, non-rivalrous resource. I guess that's what you guys would call these things. But it is not shared freely, because if data is such a strategic asset, then it makes sense for a platform to keep the data to itself. But using the data, you can get into what are called as adjacencies. Why would Google be in self-driving cars? Because Google first had search, search led to local search led to maps, maps led to street view led to data on everything around them. Machine learning became more powerful. You could start recognizing objects on the road, and all this came together to create the self-driving car. So fundamentally, when you have these massive data pools, you can enter other markets very easily, which is what is happening, which is why, and that causes massive reaction in the marketplace. Recently, for example, when Amazon bought Whole Foods, the prices of retailers dropped in the US, because traditional retailers said, oh my God, if Amazon, which is an online retailer, is buying Whole Foods, which is a physical retailer selling organic food, then fundamentally what happens to us? So you see this happening all the time, because people are seeing the power of data, because historic businesses did not collect data to the level of detail that these new businesses get. So data is a new kind of resource which we need to think about very strategically. Now, the other thing is that data has become more and more important because of certain developments of the last 15 years. When the data became a source of business was essentially when Google started monetizing the search. You did a search and then you could see ads and so on. And then Facebook did that for social media. And what they basically used data for commerce, data for targeting customers, data for getting, exactly understanding a person's preferences and selling him what he or she wants. So between 2000 to 2010, by and large, data was used for this kind of monetization. But the big thing in the last 6 years is the use of data as a basis for artificial intelligence. Now, artificial intelligence as an idea has been around for 40 years, Marvin Minsky and so on. You go back to the Turing machine. But what has happened in the last few years is that because there's so much data, you now are able to do a lot of things with that data. And the particularly important breakthrough was something called deep learning, which uses layers of neural networks to quickly use data to figure out something. And a good example of deep learning is image recognition. Image recognition till 2011 had a 30% error rate, which means that if you asked a computer to identify an object, it would get it wrong 3 out of 10 times. A human being gets it right 95% of the time. But from 2001 onwards, deep learning has been applied to image recognition, along with the fact that with all these devices, lots of images are getting thrown up, cats, dogs, whatever. And now, as of last year, image recognition by computers is better than human beings. The error rate is less than 5%. So you can imagine that a process that had a 30% error rate 5-6 years back is now better than human beings. And that is one of the properties that they use to make self-driving cars. Now this is happening in speech recognition. So many aspects of learning are becoming very quickly AI driven. And the fact that you have AI first of all, it gives you a huge competitive advantage because the kind of automation you can do, but that further gives a value for the data. So the data is becoming precious, not only because it helps you to make money, it also helps you to automate and do all kinds of new things and get into new markets. So data is really the oil of the 21st century. Now, an example of how data disrupts at scale, I took two examples, digital advertising in the United States and payments in China. In the United States today, Google and Facebook capture 71% of total digital spend. And you've seen what is the situation in the US where newspapers are getting out of business, television is now facing a threat. And what's important is that in the growth of digital ad spending in 2015-16, 89% of the growth was captured by these two platforms. Think about it, just two platforms captured 90% of the incremental digital revenue. This is two companies that didn't exist 15 years back. In China has been the rise of digital payments. China is, we talked about, Ken talked about the curse of cash. China's mobile payments is $5.5 trillion. It's 50 times that of the United States. And the Chinese have done an amazing job of using QR codes. So you go anywhere in China, you can just point your smartphone at a QR code and make a payment. However, these payments are dominated by two companies. One is Alipay, which is part of the Alibaba group, and the second is WeChat, which belongs to Tencent. So between these two companies, they own 90% of the payment market in China. And so you have two dominant companies who own payments in China and two dominant companies who own advertising in the US. So this is a good example of how data has this self-fulfilling prophecy where the more data you have, the better you get. And ultimately, it's very difficult for a newcomer to enter into this area, and therefore you create these winner-take-all scenarios. Now, when you combine the data with AI, you also get both scale and speed. Again, I'll give you one US example and one Chinese example. In US, look at Netflix. 10 years back, Netflix was stuffing a DVD in a FedEx envelope and sending it to you. And 10 years back, in 2007, the same year that iPhone was launched by Apple, Netflix launched a video streaming service. And today, Netflix has over 100 million customers watching video on their service globally. The difference is Netflix has data on who is watching, what they're watching, how they're watching, when they're watching, and what do they like. And they're using that data to decide to help them make better programming. Now, when Netflix began, it was not really in the content business. It was a distribution company which initially began with DVDs and then went to streaming. However, in the year 2013, Netflix started making its own content. And the first show it did was the House of Cards. I'm sure all of you have seen House of Cards. And then they went on to make many other shows. And now, what is interesting, if you look at this year's Emmy Awards, Netflix got 93 Emmy nominations. It's incredible that a company that came into content 4 years back has got 93 Emmy nominations because of all the fantastic shows they have. And HBO, which is the granddaddy of this business, the company that produced Sopranos and Game of Thrones, had 110. So this is the power of a company which has so much data about its users. One of the inventions of Netflix is called post-play. You guys know what is post-play? Post-play is that when you finish seeing an episode, if you don't do anything, they start the next episode. It's designed for binge watching. It's designed for you to see the whole of House of Cards on a weekend. If you're seeing a movie, at the end of the movie, they will start a movie which they think that you will like based on the data they have about you. So as they say, Netflix slogan is more viewing, less sleep. That's their That's their, they're saying they're only competing with sleep. There's no other competition for Netflix. Similarly, if you look at China, we talked about Alibaba and how Alibaba basically is the big guy in payments. Now, using that leverage, they developed an app-based money market fund in 2013 called Yaobao. It's called leftover treasure, which meant that just keep that, loose money you have with us, the rest of it you keep in the bank. Within 4 years, it has become the world's largest market for mutual fund. It has about $165 billion in mutual fund. This is not a bank, this is not a mutual fund, this is a product they created, and they were able to use the data they had on their customers to sell to them this product. And so I'm giving you 2 examples of how this new world is changing so fast, where data plus AI allows you to dramatically scale up and enter markets that you didn't think about. And therefore, you see this playing everywhere. I mean, the first market was advertising, then retail, then media, then we had entertainment, we have, you name it, everywhere, financial services. So suddenly, every market, this data plus AI is disrupting at scale and speed. So what we are seeing is platforms that accumulate user data rapidly disrupt industries and wield disproportionate influence and create silos because data is their asset. This leads to what we can call as data domination. We're already there. You start worrying about it as policymakers. Now, the world is just waking up to this challenge. Currently, the EU is very active. They are bringing in very advanced privacy laws that come into effect from May 2018 called the General Data Protection Regulations. Recently, they did a big fine on Google for promoting their own retail selling product. The UK has asked its 9 top banks to open up its data so that they can create innovative competition. This has been done by the CMA. Japan has just announced very tough anti-monopoly rules on data. They announced it last week. The Chinese have, of course, been way ahead on this. They have created what is called the Great Firewall. So for everything, there's a Chinese company. American companies did not apply. As you know, the last company left in China was WhatsApp. And last week, they put restrictions on WhatsApp. So I guess you know what's happening there. So China's cybersecurity law is very, very strict and actually says that you have to keep your database in China. Apple last week announced a deal where all data of Chinese user Apple will be stored in China. And even in the US of course has other things to worry about, but there is talk about all this. And the recent article in the Wall Street Journal, can the tech giants be stopped? There's a lot of thinking, but there's no real action. The people haven't really woken up to any action, and really the Europeans are leading. But all over the world, this is now becoming a huge issue. Therefore, it's very, very important that India has a strategic position on data. This is not a technology problem, this is a policy problem. It's not a technology, don't say, oh, these techies are saying something. This is a policy problem because the most important resource of the 21st century, which is data, you need to have a strategy. You need to have a way to think about it. And when you think about this data, there are 3 different dimensions of it we need to think about. One is what can be called as data colonization, which is that more and more of your data is outside your shore with somebody who is essentially unaccountable to your laws, which is what is happening when you use these things. Second is privacy, which of course there's a 9-judge bench discussing it, so I won't add to that. And the third is the winner-take-all behavior of data, which leads to monopolies. So basically, the reason why the public policy thing is so confusing is there are multiple dimensions. There's a competition dimension, which is where the monopolies and all come in. There's a privacy dimension, and there's a national security and national kind of dimension about how do you create domestic champions and whatnot. So there are 3 different dimensions, and people tend to mix up all these 3. So I'll just sort of segregate the 3 things. But it's important that you have a strategic position on data. It's very, very important that India has it. China has made a huge commitment to data and artificial intelligence. They are just going all over. They're going to do it in a way that it just essentially the US and China are becoming the two big leaders in AI and data. Therefore, what can India do which is different? And so we are suggesting, and this is after a lot of things, is how do we invert this data? And what do we mean by inverting the data? We say that instead of the data being owned by companies, or instead of the data being owned by the government, can the individual whose data it is, can he or she own their own data? In other words, can we invert the data pyramid so that data belongs to the individual? And the beauty of it is India is actually in a place where we can do that. So inversion of data means instead of data being used to sell things to you, data is used to empower the user. Is there a way we can think of a policy and technology and infrastructure solution where data can empower each user so the user takes the benefit of his own or her own data? And when you invert the ownership of data, you take your data from various producers of this data, and I'll explain later about the kind of data producers that India is creating, and use that to get benefits for yourself. So think about it. If you invert the data where every Indian resident can use his own data for his or her own good, or every Indian small business can use the data for their own good, then you have changed the whole equation. So you're basically given data back to the people. And as Calvin said in 1995, we don't trust anybody, right? We don't trust government, we don't trust that. So if we can't trust anybody, and since everybody says we are this libertarian society, we can only trust ourselves. So the best thing is give data back to the people. Give people control over their own data. That's the best way to solve this problem. And the reason why we are able to do it is that over the last 7 years, India has built the technological infrastructure for every user, be it an individual or a small business, to be able to get his or her own data from any data source in small packets in real time. Because to really actually make it work, where an individual can use his own data, I should be able to get my data on demand from anywhere in real time. In 2 to 3 seconds, I have to get my data. Fortunately for us, we have the infrastructure to do that, where you can go to your data source consumer, you can ask for your data, you'll get the data in real time, and you can give it to somebody else. So this is possible, only place in the planet where this is possible in India, and therefore we must make use of the infrastructure we have to implement this inversion of data where we put the user at the center of it all. Now, how does this help the three things? One is it prevents colonization. Now, when I use the word colonization, I'm not using it in a protectionist sense. I'm not saying keep guys out. I'm saying it in the sense that when there is data collected in India by anybody, be it an Indian company, be it an international company, be it the government, I should have the right to claim my data back. And by the way, none of these guys give it back to you. Or they give it in, it's practically impossible to get it back. So we must be able to get our data back so that if we can get our data back, then I can participate in a different AI solution to get value from that. And I should be able to take my data from any service provider. Now that's a matter for Indian law. Indian law has to say that. Nothing to do with, so this can apply to an Indian company or a foreign company. So there's nothing to do with protectionism, but ensure that user gets his own data back. And that has to be part of your policy, and that has to be part of a law. So when you talk about laws, we need to think about how to create laws where the data comes back to the user at his request. And that will help in preventing this phenomenon, because ultimately I can get my data back from anybody. Second, inverting the data defends privacy, because now, the privacy argument is that, private companies is fine because you're giving consent. Now, anyone who has signed a consent for any of these products, I don't think anybody's read what it says, but fundamentally, you have to either take it or leave it. Either you take the terms of the contract or you don't join that product. And all your friends are on it, then you end up having to join it. So the best that we can have a situation where I can negotiate terms with the service provider on what they do with my data, and that again is defends privacy because I have control over my own data. And this again can be done by a law for those services provided in India, whether it's by an Indian provider or a global provider. And the third important thing is data portability of this time enables competition and innovation. Because once my data is portable, so the same reason that you think about mobile number portability for telecommunication competition, the way you think about bank account portability for banking competition, you have to think about data portability, which means that I should be able to get my data from my current service provider and give it to somebody else if I don't like the way I'm doing that. In fact, there's an article in the New York Times by that Zingales, who's co-author with Raghu, where he says that your social media graph should be portable. So if you're on one social media project platform and there's a graph, let's say I should take my graph and go to another product, and that's how we increase competition. So this creates real user choice. So fundamentally, if you can invert the data and give it back to the user, then you address three different things in one shot. You address the issue of colonization, you address the issue of privacy, and you address the issue of continuing to create competition and innovation. So this is what we will call as data democracy. So data is empowering when it is in the hands of the people. We must invert the data, thus ensuring freedom and choice. Think of this as data democracy. When you think about it, when India made a decision to have a democracy where everybody got the vote, it was a very major step at that time. People said, oh, only educated fellows should get vote, this, all that. Because they said the only way to prevent anyone else from ever coming back is by giving power to the people. So exactly by the same logic, we have to build a strategy where we give the data power back to the people. And the time is now, because India is now adopting digital at an unprecedented pace. We can see that Jan Dhan Yojana bank accounts close to 300 million. 1.16 billion people have an Aadhaar. 350 million people have smartphones. Mobiles is about 1 billion. Every second, 3 more Indians are experiencing the internet for the first time. And for all Indians, the internet is coming through the mobile phone. So Indians are mobile first as far as internet goes. So this is happening at a phenomenal pace, and you're going to see this happening all the time. And this is a government initiative to make sure that we have this jam and so on. And it is now becoming the preferred mode of transactions. There's a product called e-sign, which allows you to use the Aadhaar number for signing a document. Before, this was designed by my friend here, Ram Sevak Sharma and Pramod Verma, Sharma and Verma. Huh? And before that, you used a dongle which you put into the PC. Since inception, there have been only 20 million signatures using a dongle. In the last 3 years, there have been 21 million signatures using e-sign. I mean, e-sign has already overtaken dongles, and now with GST coming and you have to sign your tax returns and all, the e-sign will go through the roof. DigiLocker, again something that Ram Sevak launched, has 4.8 million users, has about 6.9 billion updated documents, 17 databases of the government, including the driver's license and vehicle registration, is now in a government DigiLocker. UPI, which was a platform launched a year back, which was promoted through Bheem, today is the fastest growing digital platform, reached 10 million customers, 10 million transactions in the month of June. And where RBI, Viral, your predecessors, were very supportive. eKYC is used to electronically open a bank account, get a SIM card, get an insurance policy, get a pension, get everything. Already done 340 million eKYCs in 3 years. Authentications of Aadhaar is doing about 800 million to 1 billion a month. On June 30th, Aadhaar authentications was at 40 million on one day. Talking about, they're talking about 1 billion authentications. They're serious volumes. You have national class systems being able to do that. And then in the DBT, we have this thing called the Aadhaar payment bridge, which connects your Aadhaar number to your bank account. It now has 500 million entries. 500 million Indians have linked their Aadhaar number to the bank account, and runs the world's largest direct benefit transfer system, which has done more than 2 billion transactions worth about $9 billion. And that is only going to go up as the government promotes DBT for everything like kerosene and fertilizer. So you have this, so what we're talking about is not vaporware, it's real, it's working, it's happening at scale, and it also provides the ability to invert the data and give it to the user. So what this means is that India will go from data poor to data rich in 3 years. So the rate at which data you're growing is fast more than GDP growth. You know, data is going to grow at a much faster speed because all these things are happening simultaneously and allows you to change your service offerings. And India has unique digital infrastructure in 2 ways. One, through the Aadhaar, the locker, UPI, BHIM, all this stuff, we have what we call collectively as the India stack, which allows you to do transactions at a very low cost. At the same time, we have some major platforms that are going live for business. GST, of course, everybody understands GSTN, FASTag. FASTag, you think of it as Aadhaar for a truck or a car. So today we have about 500,000 vehicles which have the FASTag, is being promoted very actively by Mr. Gadkari. And about 15% of toll transactions today are happening through FASTag, which means that I don't have to stop the truck. I just drive by and there's a beam which reads your tag and automatically debits your bank account. So right now we're doing 7 million transactions a month in India on FASTag. Okay, all these quiet revolutions are happening. And that is going to grow because all truck traffic will be using that. And then there's the Bharat bill payment system, which is going to essentially convert all bills into paperless bills, and that will do 3 to 5 billion bills a month. So these are all massive national scale systems, all of which are going to generate a lot of data. So suddenly we have digital infrastructure for consumers and we have digital infrastructure for businesses all coming in at the same time. The other important thing that we have is the world's most unique authentication infrastructure, because if you are going to go digital, how do you know that the person you're dealing with is the right person? This is a huge problem around the world, that it's called authentication. And typically because of the fraud and all that, the increasing belief is we need to have 2 factors of authentication. I should be able to not only know your card but also your PIN, all this 2-factor authentication. RBI has been a leader in that. Now India is the only country in the world where I can use the entire JAM infrastructure for authentication, because Aadhaar itself provides biometric authentication using fingerprint or iris. The mobile phone authentication is there using OTP. You can verify that the mobile phone is what you possess. But thanks to UPI, we now have an interoperable PIN infrastructure for the country. In other words, if RBI permits, a bank can start offering authentication services with its PIN number. So instead of, if you want to verify yourself, you give your PIN, it goes to the bank, bank says he's the guy. So suddenly you have 3 national infrastructures for authentication. And so this is something which nobody even has, can dream of having this kind of infrastructure. And then you can mix and match this with, you can use the driver's license as your KYC, you can use your PAN as your KYC, and you can access this from any device. So we have this infrastructure for 1 billion people working now. And this is again is a huge, huge strategic benefit for implementing this, because ultimately how do you make sure the real person is requesting it, how do you authenticate him, how do you do transactions? And an important point to realize is we can't use Western business models here. The West became data rich, became economically rich before they became data rich, which is why the businesses that happened in the West was those that could use data to sell ads to you or to sell products to you. You're already rich. So it was really a substitution business where business migrated from television and print to digital, or from physical retail to digital. But India is a country where that's not going to make money for you, because the total spending in the per capita spending in the US on advertising is $591, is barely $8 in India. It's about 60,000 crores a year on advertising. So you're not going to make money by selling ads. Therefore, how do we think if India is going to be data rich before being economically rich, the business models that will emerge are those that allow people to use that data to improve their lives. This is the fundamental mental shift that you have to make. For example, a business can use his data to get credit because now there's a digital footprint of his activities. He can now go to a lender and say, this is my credit. GST will be a huge thing for that. GST has 8 million taxpayers. Average number of invoices per taxpayer is 120. Every month you are going to have 1 billion line items of taxes paid. And a company can go to GST and say, give me my list of invoices for the last 6 months and give it to the lender, and the lender will give you money. The data will democratize credit like nothing else. So we are sitting on the verge of ensuring that instead of credit going to those house of debt guys whom we are trying to clean up, it can actually go to 8 million businesses who have never got credit from the formal economy. So sitting on the verge of that explosion because of the data that you have. Similarly, I can use the ETC data to give a trucker a loan, because a trucker will give data from ETC saying, look at I made 10 trips last month, and I know, and he can show the records, and he can take a loan to buy one more truck. So suddenly you are making it possible for everyone to get credit using data. The same thing will happen for skills, because part of our problem is that we have no way of differentiating earnings, because we have no idea whether the guy is skilled or not. So whether he's a trainee carpenter or a master carpenter, we pay him the same. But if you're able to create a digital record of training and skills on a trusted system and then do the whole loop of credentials, then people will start learning skills and making more money. So the whole virtuous cycle of skills can start. So what fundamentally, going back to economists and Lemon and all that, it's the Lemon, right? That famous, huh? Yeah. I know, the bad Lemon. I know that, Stiglitz and all that. So we have a chance to eliminate knowledge asymmetry at scale. Think about it this way, that we are in a society where there is massive knowledge asymmetry because people and businesses are invisible to the system because they're not part of the formal economy. Now, for a variety of reasons, whether it is the carrot or the stick, you're going to have a massive migration of individuals and businesses into the formal economy. A concomitant implication of that is they're going to create digital footprints at scale and speed that you have never seen before. And that will remove knowledge asymmetry. And you need to leverage that knowledge asymmetry to make sure that the economy gets momentum. And that is why it's so strategic that this data cannot be in silos. You have to make sure that this engine of growth that you have is put to work for the people and not in any other way. And this is something which is eminently doable. Now, the other thing is, again, since it's all economists and macro guys, we now have the instruments for managing the economy on a real-time basis. Otherwise, you'll argue about some CSO, NSSO, this, that, 2-year back data, all that gone. In real time, you know the exact state of the economy. Because when you have 1 billion invoices a month in the GST system, not only you know the business, you have the product code in each line item. Every line item of an invoice in GST has something called the HSN code, Harmonized System of Nomenclature, which identifies what product it is. And every service in GST has a SAC code, which is a service activity code. So whether it's a hair dye or a haircut, you have a product code out there. I think so, I haven't checked these two, but it sounded good. So suddenly you have 1 billion invoices at a product level, and from the e-way bill you know exactly where it went. I mean, you guys don't need to go to anybody else. You can get every Friday, you know exactly what the economy is going and how it happened compared to last week. So you have real-time data from the ETC system. You have real-time data on truck movement, and when you combine the truck ID with the e-way bill, you also know what's on the truck. So you not only know the HSN codes of what's on trucks, you know exactly how much went, so you know exactly how many steel rods were sold in Aligarh on the 7th of June. This is the kind of data you guys are going to get. somebody should be doing something. Nobody's doing anything, huh? Who should I talk to on this? Arvind? And then if you go to NPCI, on a real-time basis, I'll know exactly how the economy is becoming cashless. I know exactly how many transactions happened that day on a UPI, on this, on Beam, whatever. So suddenly, whether it's the cash to cashless, whether it is goods, whether it is trucks, you have real-time data. So I'd earnestly urge someone to think about how can we develop a modern, state-of-the-art system to drive our economy using real-time. And there are many more examples which I can give you, but somebody needs to work on this. So this is something which is a byproduct of this whole data stuff. So what is the specific recommendation that we have? This is 3 simple steps. The good news, no money, no budget for this. It's only brain power, no money required. First, make all public databases unlocked. In other words, I should be able to go and get my income tax, just like GST when will give my GST details, I should be able to go to my income tax and get income tax details. The income tax department has done a great job. They have a product called Traces, which gives you my TDS returns. But you need to streamline it a bit. There are some issues that we have to address there. Similarly, the driver's license details will come from the digital locker and so on. So government can say that all databases, a person should be able to access his or her own data. This is just, all it requires is a fatwa. It doesn't need no money, just a ruling. And it's also in line with the way we think about it. I mean, when we did RTI, Section 4, the RTI requires you to give public information proactively to the public. This is an extension of that, where private information of the consumer or the business will be given to that person with his consent very easily. So we have to do this proactively for government kind of databases, all these things that are coming. The same thing is required to be done by regulators for the respective fields. So the Reserve Bank has to tell the banks have to give the bank statement to the consumer. The SEBI will have to tell the mutual funds, you have to give a mutual fund transaction to the consumer. This data is not being given to somebody else. There's no privacy issue. You're giving the data to the owner of the data. But you can standardize this. So all the regulators, telecom regulator will give the details of my usage, because usage is used for giving credit for small people. So all that can happen. And most important, you need to create a law which is a data empowerment law, which is part of this whole debate of privacy is taking it away from the bigger issue is how do we get Indians to use their data properly. And therefore, we need to have a law that whoever collects data, be it an Indian company, be it a global company, be it the government, all of them will share data to the consumer or business at his request. This is a very fundamental thing we need ASAP. All these 3 things involve no money. They can be done immediately, and you can put the economy in a cycle of growth using data. So we think that we really can solve our hard problems by empowering users with the data, removing knowledge asymmetry at scale, and bringing the cycle of innovation back. Thank you.
Thank you. Wonderful version of reimagining India. He said you had your chance.
Why not? Why not? I don't want to give my data, my privacy.
Please give the others a chance, please.
Don't give.
Please give others a chance. Yes, right at the front. Right at the front.
Yeah, this is Mr. R.S. Sharma, chairman of TRAI, and the co-creator.
It's a wonderful presentation, and the way you say in a very sort of visionary way. 2, 3 things. One is that while it is very obvious that this data has lots and lots of value, currently government is having huge amount of data. Because a lot of digital transactions are happening. You pointed out to some of those which are happening on Aadhaar and other platforms. There are many transactions which are happening at the state level, wherever, all kinds of levels. And somehow people do not realize that this data is extremely useful for your own public policy making and otherwise. What is happening is that even, there is a project called opendata.gov. There you are sort of supposed to share that. That's also not happening. So actually, it's not really a question of law, but it's a question of implementation in that sense.
No, that's why I said, Ramsey, there are 3 categories. existing government data, publish it proactively under Section 4 and put it on .gov. That is government executive action. Regulators enforcing this openness is regulator action. And then there's a law for everybody else. So you need to do all three.
So what I'm saying is that the awareness in government system and hierarchy regarding the value of this data and the analytics they can do for their own uses and creating their own value, that unfortunately, so there's a need to have an awareness program. I just wanted to make that point.
That I'm sure Mr. Garg will look at that.
The second issue is actually what is happening is that there is much more serious problem here in the data space in our country. We have an example where Apple is collecting data. Apple is selling their iPhones, and they are putting all the data of their iPhone into the whatever their iCloud. Now when, what they're doing, they are saying that this user of the mobile phone has given me his exclusive rights of controlling his data. Not only they do not allow him to have his data, they don't allow them to share his data with anybody whom they want to share. So for example, the regulator TRAI made an application for, measuring the speeds. How is the speed of the data, or measuring the unwanted commercial calls. We wanted to prevent them. And we wanted people to report these UCCs to the TRAI or to the telecom companies. They said, no, you can't have access to your own phone logs. You can't have access to your own SMS logs. I think this is
one of the reasons that the Chinese have systematically is they say, you guys want to play in our country, we need to see the data. I don't know if you saw what happened recently when the Liu Xiaobo, the Nobel Prize winner, died. Guys were tweeting pictures of an empty chair, because the empty chair was the symbol in 2010 at the Nobel Prize, because he couldn't go personally. The Chinese system was intercepting those images in real time and deleting them. Can you imagine that they were actually reading WeChat messages, and so they will not allow anyone to have these black hole of data. So you want to play their game, you play by our rules. But I agree with you. I think all these are becoming black holes.
And actually they are becoming very, very powerful, because when I talk to even lawyers, they say there is no remedy to this situation in current law.
Yeah, I think.
Nandan, thank you very much for a really very, very inspiring talk. I learned a great deal from it. Just one question on the sort of democracy of data. That I understand saying that that if you do all this, that I own my data. But as you said, you're not stopping Apple or anyone else collecting your data and thereby getting network effects and the monopoly, etc. So I didn't quite understand how what you proposed affects that part of it.
No, I think if companies have a lot of customers and if they're able to use AI and slice and dice it for benefit, I mean, that's fine. That's what businesses are for. But they have to be, the data protection and privacy law will have to say what they can do and how they're accountable. And they already, like I tweeted a draft yesterday. There's a paper by Rahul Matan on how to monitor this, or how not monitor, how to enforce this. Please have a look at that paper.
But sorry, just on this, so that the incumbent still they will have all this power and still makes it very difficult for a new.
Yes, but if I have data portability, then at least I can go to a second provider. Today, for example, if a new social media company comes and I want to export myself from my current social media provider to that with all my friends, I can't do it. You're locked in. That's why actually, if you look at what's happening, both in the US and China, the innovation around is actually slowing down because you can't create new guys. Yes, Arvind.
Nandan, I completely agree with absolutely wonderful talk. I just had one small question, which is that, go back to kind of, behavioral theory and stuff, that you want to give me back my data. I'm relatively educated, but, in terms of the ability to actually, know what I have, what I can do with it, there's a huge spectrum across India, like in terms of digital access. So when you design this law, this empowerment law, should you have some features of, defaults, that take account of this kind of, the fact that digital literacy.
Yeah, no, that is probably more a regulated thing. For example, RBI, actually all the regulators have come out with something called account aggregators. So account aggregators are already notified by the RBI, and it applies to all the 4 financial regulators, which are new class of companies that will help consumers to, so a third party aggregators where you keep your data by choice. So all these kind of guys will emerge who will provide this as a service. And then of course you'll have to look at rules of fraud and all is probably more a regulatory level, consumer thing, because this is such a wide area, you can't do it at the law level. You provide for the framework.
Okay.
Yeah, Nandan, very fascinating talk and the slides, and I hope these slides will be available.
No, not yet. I'll after a few iterations, I'll give them out.
Right now, see.
After the inversion has been done.
No, the question that I wanted to raise actually follows Ram Sevak Sharma's intervention on Apple. Now there is a political economy angle to it as well. You mentioned about China. I don't think we are still in a position with that kind of.
No, I'm not saying do China at all.
No, hang on.
No,
hang on.
But please be brief, Pradeep, we are running out of time.
No, I will be brief if you will please allow me to complete. What I'm saying is, now Apple, the way it is behaving.
Is it a comment or a question?
No.
If it's a comment, please save it. If it's a question, just ask the question.
It's a comment.
Then please hold it. There are people waiting to ask a question. The lady in front.
I think Rohini wanted to ask.
Yes, I have a very quick question. I'm Sabina Devan from the Just Jobs Network. My question actually builds on Dr. Mohan's question, which was considering that these big companies, the FANGs as you put it, are these massive aggregators, and to what extent will they prevent the inversion that you're talking about? So my question is more of a political viability one, considering that Google and Apple and Netflix are so powerful.
You are a sovereign country which can pass laws. You can pass a law that anybody doing business in the country has to give data. I mean, what's the complication?
You can pass the law, but can companies that have special interests, that have influence, do you think that that's
a different political economy. But today, the GDPR in Europe is categorically putting laws on what companies can do in Europe. China is a very strong cybersecurity and data protection law. The Japanese have begun the work. I mean, you decide whether you want. Look, please understand that colonization in the classical sense started when Thomas Roe came to the Jahangir's court in 1614, and the empire happened on 1857. This colonization will happen in 10 years without one gun, one shot being fired. That's the problem.
Yeah, really wonderful, Nandan. My question is related to Arvind's. So we know in social science now that default settings are really important in behavior and in what we choose to do. And I've often felt that, this thing of do I accept, it follows on what was being the concern that was back there as well, accept conditions or, allow my location to be known. Do you feel that it's actually feasible to design law that allows for much more active choice in what I want to see, what data is taken? Do you feel it's desirable?
No, I mean, it's difficult. I don't know how much it will be at the law level. But there's enough work happening in financial services about mis-selling products. And there's a lot of work happening. Viral probably have been following. In the US, they're talking about simplification of what you can say. It's under the Dodd-Frank Act. They have put down some requirements. So, I mean, there's no clear answer for this. But yes, we have to simplify. I mean, I want anyone in this room who's using a product to tell me they have read the full terms and conditions of what they use. I guarantee.
That's exactly why it becomes important.
Yeah, but if the law says that you have, by law, if you're operating in this country, you have to share your data back, then he cannot have a condition in his agreement that opposes that. Today you don't have. So he can put any condition. He says, your data belongs to me, which is what is happening. So that's why the law is important to stipulate what are the fair terms of trade on data between the private provider and the individual.
Okay, we're running out of time. One here, and the last one here.
Okay, so
three more questions.
On the economics of it, I entirely agree with you, sir. But it's on a larger issue. With the artificial intelligence and the kind of knowledge that artificial intelligence is able to gather, will that be a threat to human race first? Will that be an issue? Will that be an issue for the safety and security of the country 5 years and 10 years down the line when the artificial intelligence decides to dismantle your system without coming into you?
No. Long before artificial intelligence become the new overlords, you will have the destruction of jobs by AI. That's a bigger issue. Right now, worry about job automation. The overlord business, thoda time hai.
Okay,
yeah. Nandan, excellent presentation, and you are focused on the privacy and the ownership. And I think this is, for example, health data in the US will eventually migrate to this also, individual ownership. I've been to some. But there is another dimension which actually affects the broader economic one, which is the nature of regulating platform competition, where many of the rules of the game, the way you manage competition, antitrust, etc., many results get stood on their head. You haven't focused at all on that side. What about that?
So I mentioned,
you mentioned it.
I have three pillars. One is the colonization, which means have a level playing field, Indian or foreign company, on how they can collect data. Second is privacy. The third is the winner take all, which is about monopolies. And I said that classical monopoly antitrust theory doesn't work here because classical antitrust theory works on the principle of consumer welfare and prices.
Right.
Now here you have good consumer welfare and no prices. So you can't apply that logic. So you have to have a new way. So unfortunately, from what I can see, there's not enough thinking. The US is not doing anything anyway. So they're
they're doing.
Europe no, in the sense there's no active. I mean, the last antitrust was Microsoft, right? So in Europe, there's a lot of activity on this. And by the way, the Japanese thing is coming from their Federal Trade Commission. It's not coming from the privacy guys. It's coming from the FTC.
But okay, please, Anupam, please. Okay. We have run out of time completely. Very lively session, lot of questions asked. Many people didn't get a chance to ask questions. I think DA will answer these questions in next year's survey. Will you please join me in thanking Nandan?
We now hand it over to the Chief Economic Advisor.
So good afternoon, everyone. Now, this is the last session of what's been a really rich, exciting, visionary set of talks and interactions that we've had, with beginning with Deputy Prime Minister Shanmugaratnam, then Ken gave that lovely kind of historical as well overview. Nandan's given this thunderously visionary view of how we should think about data. So, I mean, in some sense, all those were about, some aspects of what is a good message or the right message. Now, this concluding session is going to be about the messenger rather than about the message. Now, I don't know how many of you are aware, and Ken and Tharman and Monte can all know very well, that once upon a time, the kind of, at their peak, economists had huge influence, and I guess for me, the iconic emblem of that was, of course, Professor Jeffrey Sachs of Harvard jetting around from Bolivia to Poland to Russia, giving advice on, how to change the world. And, it seemed like economists were doing very well. And then we had, I think, this cover on Time magazine with Larry Summers, Stan Fisher, and someone else saying, what was the title of that cover? The Committee to Save the World. It's kind of the high point of economists. Somehow I get the sense that today, 15, 20 years on, the world has kind of moved on a little bit from that conception of, the economist as the savior of the world. To discuss that and related issues, we have, again, a terrific panel. We have, hardcore academic economists like Ken. We have, amazingly influential policy makers who are also kind of economists, technocrats. So we have the whole range of talent here to discuss this question. Let me kick it off. I don't know how much time we have. We have about an hour for this session. Yeah? Well, 1.5 hours, okay. So let me begin by actually raising the basic question and asking, is it a fair assumption that actually economists and economics is a little bit more under siege and economists have lost a little bit of credibility compared to 15, 20 years ago? Is this true? And if so, why? That's my first question. Perhaps I should begin by asking Ken to lead off the answer to that question.
Well, it's funny. I have a little bit different perspective on it because I'm older than you, I think. And if you go back further, political scientists dominated the news during Henry Kissinger, the Nixon years. I mean, economists had a little heyday maybe in the 60s, but people were interested in intergovernmental relations, political questions. And I see what's happened, and I'm speaking of the West here and not necessarily of India. I see what's happened is political tensions and political issues just dominate. I actually, by and large, avoid being on television these days because they're going to say, what do you think about Donald Trump's policies? And I said, what can you say? I mean, there are no policies. It changes from one day to the next. No, I don't know if he's going to be impeached. And yet, this is covered 24/7. It's like watching sports, and I watch it. And I think you can go around and and look at what's happened in Russia with Putin, what's going on in the European Union. So some of it has been a rise in political uncertainty. I think another piece of I would put that's maybe a little more and also I think we had in terms of emerging markets this big transition in the exchange rate regime, where just one country after another went off fixed exchange rates to floating exchange rates, which economists, most of them, not all, said was a much better idea, and it is. But once you've done it, it solves a lot of problems, and so you're having less of the drama than you have when you have fixed exchange rates. But I think another factor which sort of maybe goes back to the political side is the slower rate of growth that we've had, particularly since the financial crisis, which I think has been a big factor in feeding the populism that the Deputy Prime Minister talked about earlier, really made this point. But because, back when growth was faster, and I think that in China this still works, maybe works to some extent in India, and you tell people we have free trade, we have free competitive markets, yes, you lost your job, but actually your children are going to be much better off. You're going to be much better off in just a couple of years. Be patient. And when the economy is growing per capita terms at 3% a year, it works. You're doubling output per capita every 22 years or 23 years or something like that. And suddenly, when the rate of growth drops to 0.5% or 1%, and you're telling people, well, in 70 years it'll be twice as good. They say, I don't care about 70 years from now. I don't care. I care about my children, my great-grandchildren. I'm not going to think about that. And that's, I think, also changed this populist dynamic that we have very much. So I think there are these overarching, these overarching issues. I actually think if we had another financial crisis, we'd be back in business. The former chief economist before me at the IMF, Jacob Frankel, came up to me when I first started. We were just entering the 2001 recession, and he said, Ken, this is great. A recession is to an economist what a plague is to a mortician. And so, I mean, I think I would say there's a lot of that.
Yeah. But Ken, I'm not going to let you off the hook, but I'll pose the question to Tharman instead, because Tharman, you're head of the G20. Many of these issues have come up, but there is a sense in which Ken and others that, the fact of the global financial crisis was a kind of landmark in the way economists were viewed, partly because many felt that, either people didn't anticipate it, or even if they did, they didn't act upon it, Greenspan, Bernanke, whatever. So is it therefore, Tharman, fair to say that, the crisis did change something about how economists were viewed? Even accepting what Ken says, that, a crisis is actually an opportunity for economists to kind of move in.
Well, I think, and just to continue with what Ken was saying, and to take your question, the crisis exposed weaknesses on everyone's part. Economists, by and large, got it wrong. Politicians, by and large, got it wrong. The media and pundits generally got it wrong. And the markets also generally got it wrong. Economists are, I think, a very neat category to sort of blame or throw bricks at. But what we really saw was a general narrative that got it wrong. And more precisely, a general narrative that ignored the undertow in society. There was too much going with the flow of things, whether it's in the asset markets or house prices, going with the averages and the aggregates, and no one was really looking at the undertow. And I think the really interesting lessons coming out of the crisis, although the crisis itself was interesting and there was a specific financial, some regulatory issues to do with financial instruments and their lack of transparency, and those are being attended. But the really interesting or important thing about the crisis is that it showed up a decades-long undertow in society. And that is now leading to a lot of reflection on the part of economists. And speaking as someone who's working within economic policy rather than economics per se, economic policy must always be about how we achieve change in a real society. And a real society has people motivated by a whole range of influences, their families, their neighborhoods, the circumstances in which they grow up, and just them watching the general narrative and getting carried away by the general narrative. And if one interesting, I think it's an interesting opportunity now, if you like to have a little more of the benefits of trade across disciplines. And there is a lot of gains to the trade between economics and sociology and psychology and politics. In particular, to take Ken's point, I think we are learning a lot from the sociological research that accompanies the work on income mobility. The facts are fairly clear that there has been a significant decline in income mobility in the advanced economies. And we have especially good data on it in the US, but you can see roughly the same picture in a range of advanced economies. Children who are born around the 1940s had a very high chance of having a significant increase in their incomes compared to their parents. Intergenerational mobility, it was almost a given. At least for the broad middle of society. By the time you got to children who were born in the 1980s, the chances were 50-50. And we didn't notice this enough in the past, but we now see it, and work by Raj Chetty and others throws it up very well. 50-50 chance, even if you're born in the 80s, I'm not talking about today's generation, of exceeding your parents' standard of living. And in the Midwest, it's unfortunately less than 50%. Who exceed the standard of living of their parents at the same age, by the time they're in their 30s. But people's expectations of their future are based on past trends, and that's something that comes out of very good survey literature. So what happened to my parents in the past is something I more or less expect to happen to myself as well. I should expect to have a much higher standard of living compared to my parents. And when it doesn't materialize persistently over the years, it leads to great disappointment. not that you are worse off compared to before, but you are not as well off compared to what you expected to be. And the second very interesting piece of sociological, coming out of the sociological research, is that people assign greater importance to losses than to gains. And particularly if those losses are concentrated in particular communities or amongst a particular group of people. If I can just use the example of the now much fabled white working class in the United States, they are by and large better off than the black working class or the Hispanic working class. They're by and large better off, but they're not doing as well as they thought they would be doing. And losses are felt acutely, whilst gains are not felt acutely.
But they also have the opioid crisis that Angus details.
Absolutely, I accept that completely. But the basic point is, losses play more on the mind than gains. So when we combine these two facts, the fact that you were expecting to do the same, you thought the same would happen to you as happened to your parents, and it didn't happen, and you assign a lot of weight when you're the one who faces losses, even though you may be better off than a lot of other people, you then get these unfulfilled expectations and ambitions feeding very easily into politics. And the people who are making gains don't go about charging and making a big show of it, but those who make losses can dominate the narrative. And we've got to spend some time understanding this. And what it means is that more than ever before, economic policy has to be very sensitive to the areas where you've got losses, and particularly concentrated losses, and we should not allow those losses to be sustained over a long period of time. If you like, there's a political economy version of hysteresis, just like there's a labor market concept of hysteresis. If losses are sustained over a long period of time, they don't just fester, they get deeper and they develop a political multiplier. And things get harder to unravel once that happens.
Just going down the road, Montek, do you see this whole role of economists, the crisis, different from, because you and Bimal at various stages were, in very important positions of power, both, proffering, being a producer as well as a consumer. How do you come out on this?
Well, let's reposition this discussion a bit, because I think you are focusing too much on what happened in the global financial crisis, and in the presence of Rakesh Mohan here, who keeps calling it the North Atlantic financial crisis, it's only fair that I should say that, look, yes, that was a very important event, and I agree with most of what has been said, but let's look at it from India's point of view. Right. If you were to judge whether economists should be discredited because of what happened in the last 15 years compared to the previous 15, what you would be saying is that this was a period when the economy, instead of growing at 4.5 or 5%, grew at 7.5. What a terrible bunch of people. And poverty, which had barely declined earlier, crashed. It's still there, but huge decline. And quite frankly, I don't see why we should become party to a general perception that economists have failed, if they have, looking at the Indian experience. And I would say that even more true of China. Because after all, we're talking about the world. We were behind China. We began probably 20 years after China. China did better than we did even after we began, because they got in early. But all said and done, in this period, 20 years, 30 years, whatever, what you've seen is whoever was leading economic policy in China and the many different governments that were involved in India. Because this is one of the interesting things about the Indian setup, because the changes that were brought about span over different governments. And the problem is at any one time, if you go and talk to whoever's in government and whoever's in opposition, what you get is a picture of, well, a very controversial and highly contrarian sort of approach. But look at it over the longer spectrum. I think there's been a consensus in which direction India should move. And I have no doubt, by the way, that we didn't get to where we wanted. But the balance of advantage has to be that a lot of good things happened. So if there were, I mean, I can well imagine politicians saying that, look, we were the guys in charge, so why should we give credit to these fellows? They're the ones who caused the global financial crisis. You could make that point. But I think if you think that teamwork is a group of people together, I don't think economists have anything to be terribly embarrassed about in the Indian context. Yet, two things I would say. One, it's probably true that with the rapid growth, I would say 3 or 4 things that are negatives or disappointing. One is that growth is always associated with structural change. And a politician, if you convinced a politician that, sir, why don't you go out there and say you're going to get 8% growth, they like to make the speech as if each person who's listening to them is going to be 8% better off next year than this year. Whereas actually 8% is going to be an average. And my guess is you can't get a high growth rate without a lot of structural change, most of all in a poor country like India, right? So you've got to say, well, it's going to be 8% on average, and I'm going to make sure that the ones who are hurt are taken care of, and the regions that are hurt. I mean, many of the things that Tharman talked about this morning. You don't mind my calling you Tharman, because I should be saying His Excellency, the Deputy Prime Minister. This is the trouble with India.
I've flouted that rule, so
yeah, you're giving me bad habits. No, I think this point that he made very powerfully very much applies in India, because let's face it, we're a large country. And I recall way back in the 90s or so that I'd gone to give a lecture in Chennai. And Mr. Maran, the older Mr. Maran, the late Mr. Maran was there. And I was making the usual sort of, growth is good, and some of the states are moving ahead, and their example will be an example to others, et cetera, et cetera. And somebody in the audience, in those days, the slightest suggestion that growth is occurring was viewed with the grimmest possible suggestion that something must be going wrong. And he said, but don't you think this liberalization is going to be very bad for the backward states? And I was about to give some gobbledygook kind of answer, but then Mr. Maran, Mursali Maran, interrupted me, and he said, I don't think there are any backward states, there are just mismanaged states. Now, by the way, he came from one state, and he can make these comments about others. Since I was at that time representing the central government, we never think any state is mismanaged. But this is the issue, that yes, there are differences, but states should look at why is it that some other states are doing so extraordinarily well. And there are lots of examples one can give in India. And even some of our, until recently, better off states need to learn from others. So I won't go into that. That's one issue. Second is that, while we did quite well in the production of GDP, and I would say also in the distribution of GDP as far as poverty reduction was concerned, because it's simply not true in India that the real incomes of those at the bottom didn't rise. It rose. In fact, in India, even the middle actually rose. But there were regional differences and that kind of thing. But what is absolutely true is that health and education, which are not bought by GDP, I mean, they are, in that sense, public goods that have to be sort of provided by the state, I think we did a bad job. The good news is that we learned about it, we've been trying to do a little bit better, we've certainly been putting more money into it, and it's also true in this area that there's been progress. I mean, whether you look at maternal mortality, infant mortality, this, that, and the other, it's getting better, but it's not getting better as much as it should have. The really big negative, and I've said this somewhere, is that, it's in the environmental area. Because environment is one area where it is not even possible for us to say that things are getting better. The most we can say is that if we hadn't done what we've done, they'd have been even worse. Because every single environmental indicator shows a deterioration. And I think to a large extent, this is because it's not recognized as a problem. Now, you can fault economists because this is a classic case of externality. and I mean, every economist has known since Pigou that you need to worry about externality, and I think our policies didn't do that. So education, health, and the sort of these externalities. But you know, on the global financial crisis, let's be very clear, we didn't do the sorts of things that led to the global financial crisis. We were actually highly criticized for it during the period by your former institution, amongst others, that we weren't liberalizing the financial sector fast enough, that we weren't liberalizing the capital account fast enough, et cetera, et cetera. So quite honestly, I think we should sympathize with what's happened. We should certainly learn from it. But you know, I don't buy the notion that if you made a serious examination of the Indian experience in the last 15 years, that the economists should be going around looking really embarrassed and saying, I'm really sorry, old chaps, we shouldn't have done this.
Excellent. I think that Montek, you know, a very nice distinction between, you know, what happened in the global financial crisis and what happened, you know, especially in those countries that converged. Bimal, you were also part of this team that has shepherded India through this, you know, 30, 40 years of sustained growth with all the downsides that Montek spoke about. You've also been governor of the Reserve Bank. What is your take on the role of economists during this period?
No, you know, one point I would like to clarify is that when you talk about economics profession, don't confine it to government or government policy. I mean, that's a different perspective altogether than the economics profession. I mean, you have corporates, you have media, I mean, you would have other public institutions, you would have private institutions which are delivering services. So this is my first point, that we are not talking about economics profession. At the moment, we are talking about the professional economists in government in different parts of the world. Am I right? I mean, so yeah. On that issue, let me say that my own experience has been that you see, the politics always trumps economics. But I have found, at least in our situation, is that when there is a crisis, when there is a problem, and you have to take some tough economic decisions, then it is the political leadership which has to provide support. And just to give you the two examples, there were times when, supposing we had to take a tough decision on the interest rate policy, or tough decision on the exchange rate policy. And the elections were, in the state elections are, say, 3 months later or 2 months later, then the political view, finance minister or whoever it is, and the prime minister, that you always, they have to approve the policy. I'm now talking about government, you know, that they have to approve what you are trying to do and what is the policy, particularly if you are trying to, say, raise interest rates by a substantial amount, or you are allowing to depreciate the
treatise and undergraduate teaching. So in my undergraduate courses, I teach in advanced undergraduate courses that has mostly juniors and seniors at Harvard, and I've taught a course like this for a long time. It teaches technical material, but it's all centered around policy debates. The debates change over the years. For example, maybe 10 or 12 years ago, I think I had my class debate, should the UK join the euro? Then maybe 3 or 4 years ago, it was, how much would the UK be willing to pay not to join the euro? And then, you know, now it's, you know, has to do with the UK leaving the European Union. And the policy debates, change. But there are a lot of questions in economics that just don't have a clear answer, and yet you have to have an answer. That's an example. Should you join the euro? Shouldn't you join the euro? There are examples, should the US have a higher inflation target than it has? Otherwise, well, you know, you do or you don't. And I think, you know, these are very good ways for students to learn to think about these sharp questions. Graduate economics is another thing entirely. And here, at Harvard, where I teach, most of the students are going into academic research and maybe later into government, but a lot of them are going into academic research. They hope to influence policy, but not as much as they hope to influence academic research. And the principles that 50 years from now, you know, something will matter. I think most professional PhD economists writing to journals, as you well know, are actually, if they're thinking about policy, they're thinking 30 or 40 years from now. I talked about my book, The Curse of Cash, how large denomination notes aid crime and tax evasion and constrained monetary policy earlier. I frankly wrote that thinking, you know, this is something to work on for 10 years or 20 years. It took me a few years to write the book, and, you know, it takes, you want it to have some shelf life. You don't want to write about something that's going to happen tomorrow, and by the way, you know, no one would have read it. So I think that the general idea in academic research is you're looking pretty far out, and you're looking for very robust principles and data. And as far as you asked if the book would be different today, it would be very different. There's been some marvelous research in international economics. I have many colleagues at Harvard, although I'll particularly mention Geeta Gopinath, who was a former student of mine, is now a star researcher, has done this work completely rethinking what the exchange rate does. A summary of the research is that, for example, in India, I might have it backwards, but something like 81% of exports and 89% of imports are priced in dollars. And so when the exchange rate changes, it doesn't automatically feed into relative prices the way it did back when Keynes and Olin debated things. Even Japan has 70% of its imports and 50% of its exports in dollars, and it makes you rethink things. And there's a lot of very interesting theoretical research. There are a lot of things to talk about. Sovereign debt, an old chestnut, is constantly cycling around.
What about financial crises now? That's what I'm asking.
Well, so, okay, there's all kinds of financial crises. There's exchange rate crises, there are government debt crises, there are inflation crises, and there are banking crises. So I think on sovereign debt crises, on inflation crises, on exchange rate crises, we're actually kind of solid. I mean, there's some debate at the margins, but the literature is advanced. So the kind of advice, I was giving I wasn't at the IMF, I was giving just a small academic talk at the IMF the day the Thai baht blew, and my talk was about why fixed exchange rates were a bad idea. I had written a paper with Maury Obstfeld a couple of years earlier called The Mirage of Fixed Exchange Rates. And I think, and I'm not hardly alone in having that vision. As for inflation crises, I think we got that right a long time ago, and that's part of why inflation's low everywhere. So we don't get credit for it anymore, but if it came back, we would. And I think government debt crises, it's pretty similar. Banking crises, we understand less about. And I think there are a few reasons. One is we don't understand banks. So there's quite a tension in academics about what's the right way to think about it. And there are people who have special, I very much recommend the book by Anadid Mahdi and Helwig about this, where they took out a chapter because it was too technical that I wish they hadn't, where they said there's this whole academic literature that says banks should have their own special model and their own special kind of economics, and they really, I won't name names of who writes in this, and they really obliterate that idea. But banks are very hard to model, and banking crises are hard to understand. But I think their recommendation that you should have more capital in banks is pretty solid. So I think actually the academic literature has progressed, with banking being still decades away from our having a grasp on it.
That's great. I'm going to just, given that the rest of the panel has actually is actively involved in policy making and this, and it's a question a little bit close to my heart as well. This is the question of speaking truth to power, my fellow panelists. So think of yourself, either as consumers or producers, and how do you, Tharman, put you on the spot. You know, if you, well, or if you had someone advising you on something that you were doing wrong, what would you expect him to do or not to do, both in private and in public?
I think actually it's a very important question that has to do with the relationship between politicians and civil servants. And you're really talking about the economists amongst civil servants, but I could generalize that. I think we have seen, for a variety of reasons, a drift towards more short-term thinking in politics in many parts of the world. And it's extremely important that civil servants are the trustees of long-term thinking. How do you institutionalize the relationship between politicians and civil servants so that civil servants can have a real check against policy extremes, and particularly excessive short-termism, is a very important question. Because it's not about corruption and it's not about you know, some maldoings. It's really about culture. And I think we have to use moments of political confidence or political dominance, or where you've got a strong political result, to then put in place this institutional framework where civil servants' views have to be taken seriously in cabinet discussions. They're given in some countries you'll have to have some transparency given to civil servants' views because the cabinet or the politicians may not want it to become known that this was in fact the advice which I departed from. In some other countries you don't need it because the political culture already respects civil servants' views. But I think we have to think about that. It's not about rules as much as culture, but I think in the rare moments when societies get a situation where you've got a very clear majority in parliament, you've really got to put in place a culture that, and a set of practices that can last for some time, so that when it comes to a situation where you get hung parliaments or coalitions or you're just in a weak position politically, you just don't do as you will, which typically means taking the most expedient short-term solutions, politically expedient short-term solutions. So this is a very important issue which frankly distinguishes some countries from others. In some countries, the civil servants have very little influence over policy. And as Ken says, politics rules actually. But there's some other countries where it has become a culture that if you have a cabinet discussion, you do read the arguments very seriously that are drafted by civil servants. You even have to read the annexes.
That's amazing.
And you know, it's not about being technocratic. It's actually about what I was talking about this morning, where you have a political culture that supports good economics and where you get political reward from good economics as well. And it takes a long time to build up. Sometimes you're lucky you have a leader who's able to combine both those things. And I think, you know, thinking about what Montek was saying, it was probably relevant that you had someone like Manmohan Singh as finance minister and subsequently as a prime minister, because that was a critical period. And there was a lot of respect for serious economic thinking. He wasn't the only one, I know. But I'm just saying that, you know, individuals matter, and the type of political leaders at different points in history matter. It's relevant, frankly, today that you have Prime Minister Modi, who really is building a political culture around good economics and around trying to get rid of a very long-standing legacy of what was called invisible money and you know, the other ways of describing this this morning. But, individuals matter. So I'm not giving you a very clean answer because it's not about rules and, there are really no models for this. But we have to use opportunities when we have political strength to put in place institutional practices that last well beyond moments of political strength.
Montek, please, Ken.
Just one thing to add to your question. I think if you're in your position of working, you're an economist working in the government, you have to speak exactly what you think to the politicians that you're working with, but you have to be very careful in public, depending on your position, what you say, because you're representing the government. I think if you're an academic speaking to politicians, you pretty much have to say exactly the same thing inside and outside. I mean, otherwise it's completely hypocritical. You can't, say, well, you should do this and then say something the opposite. I think it's a very different position.
Montek, I would love to hear your answer to the truth to power question, internal, outside.
No, I agree with what Tharman just said. It's a subtle issue, it's a culture issue, and I'm sure that varies from person to person. But what he said captures, to my mind, the most important things. I just elaborate in one little way, and that is that this is where really the media and the academic economists, as Ken pointed out, that they also have a role. I mean, policy discussions are not just they're not just civil servants advising the politicians and then complaining outside if they've not been listened to.
Right.
I mean, if there is a sensible media which is watching what's happening, and there's an academic community that's also participating in the debate, then by and large, areas where differences of opinion exist will get the right amount of public airing. But obviously, a government that is in power does not expect its civil servants to be actually undermining it. So, I mean, you should certainly be speaking completely the truth, the whole truth, and nothing but the truth to the politicians when you're advising them. You have to manage yourself a little bit differently when it comes to making public statements. But there are a lot of other people who can make those relevant points and then leave it to the debate in public to see how it sorts itself out.
Do you agree, Bimal?
No, I think the issue is...
We can hear.
Okay, yeah. No, I'm saying the issue is a little more complicated. Within the government, when you are talking about civil servants or political people, particularly in a large government like ours, there are different layers and different processes. For example, that if you want to do something or change something, at least 6 ministries would be involved. And different economists in those ministries may have different views, depending on whether you're on human resources or you're on land, land ministry or skills ministry or finance ministry or whatever. So when you're talking about, there is no, and the whole process is that you come to a consensus, as it were, by discussing with your, what you might say, economists in different departments and so on, come to a consensus that this is the view we would take. Instead of increasing it by, say, 100, we'll increase it by 50 so that your ministry also supports it. And then the process would be that the civil service, at least in our system, that there is a system of saying, supposing we agree on some policy which requires political approval, then you would go to a larger meeting of secretaries and other secretaries. They would also be convinced, and then you go to the cabinet, as it were. So there is a process which is not just one economist advising the government. It is a group of economists coming to a conclusion. Then there are civil servants, other civil servants. Then there are political leadership. But any good working democracy requires that this process of consultation, the process of coming to a policy conclusion, which is valid across the board, as it were, and which has the support of the political leadership also, and then it goes to the cabinet, you see. And the cabinet has people who are not involved in that process.
Right. So Ken, I just want to slightly...
Let me just add that by and large, I have seen that our system has worked very well.
Okay.
By and large.
On that self-congratulatory note, maybe I should stop. But I mean, Ken, not to get too insider IMF thing, that, what all Tharman and Montek and Bimal have said about, the relationship of advisors within the government, in some sense also held true for people like you and Mike and Raghu at the IMF, because there the issue was, you don't want to say publicly and bring about the very outcome that you're privately kind of worried about. But there were exceptions to that. I remember most famously, Mike Musa once went public and said about the euro, if not now, when? If not 20%, how much? Or something like that. And that wasn't seen as, going out of line. So is there a kind of margin for that kind of errant behavior?
Well, I think the chief economist's position at the IMF is a unique position at the IMF, where you, over time, thanks to people like Mike, have established that you do have your own voice, and you can say something a little different than the institution is saying, but you have to use that power very responsibly, and that's, a question of judgment of how much you can disagree and go off the reservation. I've certainly for myself, one of the most dramatic things was, it was kind of obvious to everyone almost that the Argentine situation and with its fixed exchange rate and huge current account and government deficits was not sustainable. Something had to give. And there are still people who disagree with that, but I think 99.9% of economists agree with that. Well, the official IMF position was the combination of current account deficits, the countries borrowing from the rest of the world, and government deficits is not sustainable. But you couldn't mention the exchange rate regime, which was ridiculous because it was a big driver of it. So we wrote in the World Economic Outlook, we put in the fixed issue, we used that phrases. I used it in my presentation to the board, but somehow they were all sleeping. And it was approved by the board, the managing director, the deputy managing director. Well, when I gave the IMF press conference and said that, the peso practically fell the next day, which is not my intention. My intention was, the wording to get out there. That was certainly quite a lesson. In the power, and I'm not sure I quite know how to assess that, but that's an extreme example. But again, I think I was pretty responsible because they were listening and shaking their heads. It was in the World Economic Outlook. I just read the line. But I think you have to use it responsibly, and that's often a difficult decision.
Great. That's so. Sorry, I'm going to pose a one-liner and then turn it over to the audience. There are 3 or 4 definitions of a good economist or an economist. Very recently, Esther Duflo said, economists should be like plumbers, kind of fixing the details. That's a kind of micro perspective on that. Robert Solow famously said that, economists should see themselves as intellectual sanitation workers because their job is basically to flush out bad ideas 90% of the time rather than, hope that, good ideas will get accepted. Keynes said, we should be as humble as dentists in our, assessment of our importance and self-worth. Of course, Keynes himself was, of course, an amazing all-round guy who shook up the world and did all kinds of, in terms of the importance of economists, there could be no one bigger than Keynes. So, very short answer. Plumbers, dentists, sanitation workers, or mega Keynes?
I can't help but pointing to, I gave the presentation, mentioned this video, Quantitative Easing Explained, and there's a line in it where they're trying to think of, has the Federal Reserve ever done anything right? You know, how is Ben Bernanke qualified? I think Ben Bernanke was great. And finally, they're thinking, well, he has a nice beard. And then the other one character responds, my plumber has a nice beard too. But when my plumber comes and they try to fix something, it gets better, you know, et cetera.
Okay, that's, on that light note, Tharman, plumbers, dentists, sanitation workers, or, you know, Ubermen?
Well, unfortunately, I'm not going to give you a straight answer from the set of choices you gave me, but as much as to say that in the Esther Duflo version, she started with scientists who develop the general frames. Then you have the engineers who translate the general frames into pieces of machinery. And then you have the plumbers, which she felt the economists should be, who watch how the machinery works in practice, spot the leaks, spot the rust that occurs over time, and have continuous fixing, patching, fixing, tinkering. I think it is not good enough for economists to be just the plumbers. I think the economists shouldn't leave the general framing to what will really be politicians, because the scientists don't exist in this world. I think the economists should be plumbers who then figure out whether the machinery is still fit for purpose, and once in a while, not too often, question the general frame. We have to be, we need some discipline in adjusting our prior beliefs over time and not leave them untouched for all time. And we should adjust our beliefs based on real evidence of how real economies are working. And to take my earlier point, I'll just say that real economies are in fact real societies. And we should get a better understanding of what's in people's minds, how they're motivated, what are their illusions, what are their dreams. And as you gain understanding of how real societies think and act, we should be going back to the general frame of reference, theory, so to speak, but it's really a set of beliefs, and adjust those over time. So the task of a good economist, I think, is to be both a plumber as well as an engineer, as well as, I removed Esther Duflo scientists, but to think about the general public narrative, the popular narrative of the day, and not leave it untouched for all time.
Terrific. Montek.
We can't do better.
Exactly, that's great.
But you know, I would like to put in a word for the sanitary guys.
Exactly.
Because, you know, I was on a commission that the World Bank had set up under Mike Spence and the Growth Commission. And probably my only contribution really to that commission was the suggestion, which Mike thought well highly of, that, you know, instead of doing what every commission does, which is to give a list of all the good things that policymakers should do, let's give a list of 10 really bad things that they shouldn't do. So I think the sanitary business is quite important. And very often, in fact, in the public mind, the public is actually not usually aware of how bad a bad idea is. Yeah. So if you can do some good work.
Or how many bad ideas politicians can come up with.
Well, actually, there are, yeah, I don't think there's so many bad ideas, but there are 3 or 4 that keep coming back. And if you could educate the public that be deeply suspicious of this particular class of ideas, because it's been tried before and has almost invariably led to bad results, I think the economists would be doing some service.
Lovely. You have the last word, Bimal, before we turn over to the audience.
I don't want to have the last word because I agree with both Monte.
Excellent. And Ken. Wonderful. On that note of you know, happy convergence amongst the participants here, let me turn the floor, over to questions. Again, please be brief, identify yourself, please be brief, and pose a question and not pontificate, please. Yeah. The gentleman here, Ajay Jhakar here. Can we have the mics, please?
So the question about credibility of economists has not been posed by the public, it's been posed by the finance ministry when they say reclaiming credibility of the panel discussion.
Yeah.
So it's not my words, but taking cue from that, I would only say that credibility of economists in India is questionable because every inflation control strategy has focused on controlling prices that of farmers produce. And that's one of the reasons why I think so 50% of India finds economics a troubling area. And someone can comment on that. But I just want to say one more thing, that this discussion has been very good because Mr. Jalan has very clearly articulated that the RBI does not have autonomy. And that's something, because if the RBI is discussing interest rates and foreign exchange with the political class, then there's a question of the autonomy of the RBI.
Now, I'm not sure, Ajay, it's a great question. I'm not sure whether, Bimal or Montek, do you want to, actually Bimal, why don't you answer
No, I would
that?
say, I mean, this is the issue about autonomy. You have to define what autonomy is about. In a multicultural country, in a what you might say, institutional country, what you do ultimately at the sort of what you might say macro level, at the government level, it is of utmost importance because the government is accountable to parliament, to the people. So it has to be by consensus. It is not an autonomous action. Autonomy, so you define what autonomy is. And the government, if you have a view which is different from that of the government, my experience has been that if that particular view has some resonance, as it were, then you can persuade the government. But the government may say that, look, I mean, don't go by 50 basis points or 100 basis points. Why don't you do something different? And we arrive at a conclusion or a consensus, which is okay. And it has happened, by the way, in India, and that has worked, both in terms of exchange rate as well as in terms of interest rate.
Montek, the question on...
The only point I'm making is that you can't take a decision in an institution, which is like RBI, and it's not a question of dependence on the government, but government is accountable. The government and the two institutions are responsible for taking the right decision. If it doesn't turn out to be right, this is a different matter. Then the parliament can criticize you, the both of you.
Montek, the final question.
I was introducing a lighter note because Venu Reddy, when he was governor of the Reserve Bank, on one occasion was asked this, that Mr. Governor, do you regard the Reserve Bank of India as really autonomous? And he, I think, gave a wonderful answer. He said, I can assure you that the RBI is completely autonomous, and I have the permission of the finance ministry to say so.
The Governor Garu was actually plagiarizing a joke about husbands and wives and applying it to central bank governors. Still a very good answer. Questions? Yes, please. Yeah, please.
So demonetization was a big event in the history of India. And at that time, where our chief economic advisor had internally supported that, and if so, whether he had successfully conveyed his reservations, if any, to the governments.
This is a great question. When I'm asked this question, firstly, the rule is no questions to the moderator, always questions to the panelists. My second response is that, why do you want to deprive my memoirs of commercial value? So next question, please.
Very interesting panel and discussion. I just want one simple reaction, which is it time that professional economists in the government, when they give advice, is it time for them to argue against themselves? Which means tell the policymaker under what conditions their ideas will fail. Which means to write a note of caution, just like typical financial products give a sort of a footnote. That's one. Because, I mean, after all, if they call themselves professionals, I think it's time they did this also. Number two, there are a lot of trends that happen which are very nascent, and it's usually hard to detect it early enough. And usually most professional economists in the age of hypercell would come out with all kinds of ideas. How do you discern the wheat from the chaff, which is climate change was a strict no-no for many people 20, 30 years back. Today, I don't think many people would disagree on it. This is true with full convertibility. This is true with many other things like that. Now, the question that comes is, it's equally important perhaps for a professional economist to also argue against himself, but then probably put a stance. Is it time for a footnote?
Great question. Panelists, a warning, a self-attached warning label to every advice that you offer? Ken?
Oh, yeah, I mean, I think people do present recommendations that way. I think particularly if the case requires for a very clear viewpoint, you might give your viewpoint, and often in these situations there are many points of view being given. But if you don't acknowledge the other side, you're not very effective in debating your case, because someone will be sitting across from you who will debate the other side. So that's very conventional. You obviously know the famous Harry Truman, I just want a one-handed economist, because they're so used to saying it both ways, especially academics. You're going to present it very fuzzily, because of course you know that you have no idea. No, I don't think that's the issue. I think it's very often there isn't a clear answer, and they might want a clear answer, but there just isn't a clear answer of which way it's going to go. I thought I'd mention, by the way, about the financial crisis. Certainly, central banks did cut interest rates a lot. They didn't do that quickly in the Great Depression. They didn't figure that out. That was a big innovation. We didn't have a Great Depression. I mean, I think that was really important.
Absolutely. Tharman, Montek, and Bimal on the I guess a different way of phrasing the question is, Ken, of course, one, you have to argue it out. But I think the question is also one way of interpreting it to say that, if the economic survey, say, makes a projection of growth, then 6 months down the line, we should actually assess ourselves against that, whatever things we said. So a kind of, a self-assessment, a periodic self-assessment as well, as something that is what I think the question is aiming at as well. Is that good practice? I mean, after all, the IMF's VO is very honest about its forecasts. Yeah.
We do those
exactly, absolutely, yeah.
I agree. It is very good practice, both in terms of macro performance and actually also in terms of individual program performance. In fact, we need much more knowledge about, this is what we said we were going to do in order to achieve something, even sectorally, and have it documented. I mean, one of our big problems in most of the programs that we've had for the last several years is that the effort is quantified in terms of input. That the output is almost never quantified, and some of it can't be quantified until much later. So people continuously say that, well, we said we will do this and we've done it. But it's only several years later you work out whether it actually had the effect that you expected. I mean, education is one of the best areas where this is a big problem.
Bimal?
No, the point I was making was that situation sometimes changes, and you don't know that it has changed. So you should be willing to change your view if you find that the situation has changed. And it happens. Or there may be something that you have missed out, and then somebody points it out, so you must change your view. I mean, I'm now talking about economic policy making, where it matters. And there is no harm. With all the facts, often, I mean, I've seen this, sometimes are not known, and something new comes up.